Business Standard BFSI Insight Summit. And the first session at this particular hall, which is in the Narayan Vagul Hall. I'm Binu Sandhu from Business Standard, and I will be your host for the sessions that will be held in this particular venue. We will begin with the sector that concerns all of us, real estate, and what an expansive sector. From the dream of owning a house to working towards our dream house, from affordable housing to luxury homes, from commercial real estate, our offices and malls, to warehouses. We will be talking about various things, all of this, and also trends in the mortgage market, as well as factors that influence people's decision to invest in property. But before we get into all of that, I would like to invite on stage Mr. Shailesh Dobhal, Business Standard Editor. Mr. Ghulam Zia, Senior Executive Director at Knight Frank India. And Mr. Vivek Rathi, National Director, Research at Knight Frank India, to unveil the Business Standard Knight Frank report titled Banking on Bricks. A huge round of applause, please. It's a report that demystifies and makes sense of India's remarkable real estate boom, which is buoyed by a robust economy and is also a significant contributor to the economy, including in job creation. May I please now request Shailesh to say a few words and set the context for the report.
Thank you, Vinu, and good afternoon all. Well, I want to start on a sober note, and it's nothing to do with India. Construction in China has reached a point where there are now 1.5 homes for each household there. The property sector there is experiencing a meltdown caused by high debt and rising defaults. And this has put Chinese households in peril because 70% of household wealth there is in property. The fallout of the collapse of the property market and financial sector has largely been contained there, but at a huge cost to the exchequer. And there's no telling how the situation could evolve going forward. In China, the investments in property sector has been a key driver for growth, with its share in GDP rising from 16% in 2011 to a peak of 29% before moderating to around 24% 2023-24. Clearly, this was unsustainable in China. If anything, China's example teaches us one thing. The stance of policy, largely the financial policy, is to keep the needs of all parts of the real estate ecosystem, which is namely the investors, the lenders, developers, governments, but most crucially, the home buyer in mind, if we wish to avoid the China-like headwinds against real estate in the future. No cause for worry, because we don't have the situation like that. The Business Standard Knight Frank housing report that we just unveiled, Banking on Bricks, it estimates India's real estate sector to expand to around US $5.8 billion by 2047, by time we should hopefully be Viksit, contributing around 15.5% to the total economic output compared to China's 24% currently and 29% at its peak. The sector is already contributing around 18% to the total employment in the country. At a granular level, despite the Reserve Bank of India's cumulative increase of 220 basis points in policy repo rate between May 2022 and February 2023, the demand for residential properties in India has remained resilient, surging to a 10-year high in the annual sales in 2023. Increased savings during lockdowns, minimal income disruptions among mid and high income consumers, and a robust economic growth fueled this demand. Additionally, a positive trend in housing prices since 2021 created a sense of optimism among prospective buyers, driving sales further. The resurgence in demand also propelled residential launches into overdrive, underscoring strong market fundamentals and a continued appetite for housing in India. In 2024, this momentum persists, with residential sales increasing by 9% year-on-year in the first 9 months, and new launches growing by 6% again year-on-year, reflecting the confidence that the market is showing. In commercial real estate too, rapid urbanization, population growth, economic expansion, and government initiatives are driving growth. To take one aspect of the commercial market, the year-to-date data for 2024 reveals a robust office market with almost 54 million square feet of transaction already recorded, which is a 27% increase compared to the same period, 2023. This suggests that 2024 is poised to be a record-breaking year for office space transactions, driven by factors such as growing business confidence, expansion of the global capability centers, and the strengthening of the India-facing businesses. The report, which is the Banking on Bricks, dives into the nitty-gritty of and the gears that move this sector and make it a proposition worth reviewing. It presents the current scenario in each segment of the real estate industry, be it rentals, ownership, IPOs, REITs, and more, and examines opportunities if one is a stakeholder in this market. We hope you find this report useful, and we'll look forward to receiving your feedback. Now I'll hand over to Mr. Ghulam Zia to take you through the details of this report. Thank you so much.
Good morning, everybody. It's my pleasure to be on this platform. Business Standard, thank you so much. And Shailesh, thanks a lot for setting the context. I think there's hardly anything remaining. You have covered the most of it. Well, while we are working on it, let me just highlight the efforts that my team and Business Standard colleagues have put together. First of all, if you allow me, I would want to call upon my colleague Urvisha Jagashet. She is the lady who has actually worked and completed this report. That's Urvisha for you all. And of course, I can't not talk about the contribution I received from Arindam. He was through with us all through. Deciding, because as you just explained, real estate is such a vast market. Most of us relate to it because the home that we stay in or the shops that we go for to the malls, etc., is what we reach out to or to understand, or maybe offices. But the expanse or the depth of this sector is so much. To find the right aspects in front of you. Obviously, the credit goes to Arindam. Thank you so much, Arindam. And with that, I would want to call upon Vivek to take you through the whole report. Thank you so much. Vivek, over to you.
Thank you, Ghulam. Good morning, everyone. Thank you for the time. Maybe we'll take 5-6 minutes to give you a glimpse of what we've done as, part of banking for banking on bricks, the Knight Frank Business Standard report. Like Zia indicated, there's a lot to cover when it comes to real estate. And interestingly, we are in the 4th year of this upcycle in the real estate sector, particularly the housing market, which is doing exceptionally well. And all of you in your professional and personal capacities are exposed to the momentum which has built up over the last 4 years. But as we closely track the sector, we realize it's not just limited to residential, but the office space, the retail space, the warehousing and industrial spaces. And then there are emerging segments starting from data centers to operations-intensive plays like co-living, co-working, data centers, which are doing exceptionally well. Obviously, it is cyclical because of the nature of the product. But having said so, the numbers give us confidence in terms of the long runway that the sector has. So if we manage the economy well, we have a very bright future when it comes to these segments. Particularly on the presentation today, we'll take you only through the key highlights of the report, and then obviously more details are there as part of the report. Now, the real estate sector, which is about $500 billion enterprise in the country, is about 7% today. As we did assessment on a range of factors, starting from the population growth to urbanization to rising income levels over the next 25 years when we achieve 100 years of independence. We're forecasting the real estate sector to be at a scale of 5.8 trillion US dollars, which is quite remarkable. In this is the share of the sector is likely to go up from 7.5% today to 15% in 2047. It will still be much lower compared to economies like China, but a long runway compounded by factors of urbanization, rising income levels, and increasing aspirations of home buyers. Now, you got a glimpse of the performance of the residential sector, which is at a 10-year high when it is looked upon from various parameters, particularly the housing sales as well as launches. 2023 was a record year for housing, and the momentum continues even in 2024. In fact, most of the developer quarterly results, which are in the fray to come out for the September quarter, maintain the all-time best performance in the quarter of September, which is kind of an acknowledgement of how, despite some headwinds that came into the sector, including the rise in interest rates over the last, say, 2.5, 3 years, the sector has maintained the trajectory. And like I said, it's not limited to residential. Even the office market is on course to record the best year in 2024, with transaction volumes exceeding almost 70 million square feet across the top 8 cities. So certainly, in terms of performance, it is busting charts. Now, let's look at what's happening in the background, particularly when it comes to housing, which is the biggest beneficiary as well as the contributor when it comes to the interlinkage of the banking sector, particularly the BFSI sector and the real estate sector. And what do consumers want? And to understand that from the ground, the Knight Frank Business Standard team went across to understand what's happening. So as part of the performance, we've seen, the real estate sector is doing exceptionally well, particularly led by the luxury segment, which has continued on the momentum. From about 18% share in the last 5 years, it has scaled up to 42%, the higher segments across, different categories that's showing up. But that's the case. So to understand more on this, if this will continue, what's happening and what do consumers want, the Knight Frank Business Standard team went out to meet 1,600 households across the country. And the findings of this respondent group are interesting and insightful and kind of informs all of us here participating in the sector to align our products to what the consumers want, both from the real estate product space perspective as well as the financial products and insurance products perspective. What came out as part of this survey was 52% consumers, 52% respondents still want apartments, and followed by 19% wanting studio apartments. So it's more of an urban living phenomena, but clearly depending on the realities of their affordability as well as the need to be connected to their social infra, workplaces, and the contemporary demands of our customers. This is how the nature of product has been remarked. Home ownership prevails amongst home buyers. As you see in the numbers on the chart here, 80% of the respondents indicate home ownership to be a very strong anchor when they are making decisions with respect to their habitat. So different times we've seen, renting versus, buying debates. But what clearly came out, even after, the market being in the 4th year of the upcycle, property price levels going up, home loan interest rates, while they're stable for the last 17, 18 months, they've kind of moved up a lot. But notwithstanding, the need for home ownership, the sentiment for home ownership remains very strong across all age groups, starting from the baby boomers to Gen X, millennials. It is in the younger generation, which is the Gen Z, where we saw there is some inclination towards renting. But having said so, even this particular group, 71% of them are vying for home ownership, even as it is about 80% for the other age groups. Home loans are very critical factor when it comes to buying a house. Almost 80% of our consumers rely heavily on home loans, and therefore right levers have to be attended from the banking and NBFC community in terms of what brings them closer to the consumer in terms of understanding what they need. Some of the key elements that the consumers highlighted, the top one being the competitive interest rates. Obviously, this is a high ticket value product, and cost is a factor. But then it clearly came out as number one, followed by flexible loan tenure. So we've seen, while 20-25 year, and in fact, we also on some platforms we advocate a 30-year home loans, like you have in many of the developed markets. But end of the kind of past experience tells us about 10 to 12 years is when most home loan consumers close their obligation, and some interested to do even faster in case of rising incomes more than the initial plans. And therefore, flexible loan tenures came out as the second most important tenet when it came to a home loan engagement for a home buyer. And then there are obviously quick loan approval process and guidance on legal and documentation. So there are many such findings which came out as part of this survey. We've kept very limited here and more on the report. When it came to investment versus end use decision making, different consumers group have different aspirations, but clearly the baby boomers favor investing, and the baby boomers are little middle age consumers, 45 50 plus, whereas for millennials lifestyle upgrade came out as a very big reason. Now, how does it matter whether someone is buying a house? It matters when you are designing a product, devising your strategy, whether it is for end use versus end investment, whether it is an upgrade decision. So now what clearly comes out on the chart is most of our consumers, particularly in the tier 1 cities, are not essentially buying the first house, and therefore 37%, the most dominant category is upgrade to a better home, which came out. So we've seen this not just in the housing segment, we've seen this in passenger vehicle segments, mobile and electronics. Consumers are moving up the value chain after experiencing the product already in terms of the functional attribute with their earlier purchase. So now they are upgrading, and accordingly strategies are being designed by the industry to attend to this. Then there are a range of factors which came out, and the sector will have to be cognizant of it when choosing projects which are close to the consumer's aspirations. Some projects highlight consumers highlighting location, layout of the project, and affordability as the key reasons for their purchase. 65% of the consumers highlighted living in city core areas, which, and we've seen this, congestion is a factor we keep complaining about, not limited to Mumbai, but we've seen in Bangalore, Chennai, NCR, and that came out as one big reason why, 65% of them highlighted living, close to the city cores, so that they are closer to their workplace with dense social infra. Even as infrastructure is improving, and a little bit movement or acceptance will be there for suburban and peripheral markets. Then top external facilities, health facilities, shopping and retail facilities, proximity to public transport came up as big reasons when they were choosing projects. Stamp duty reduction, and in markets like Mumbai, we've seen in the past. Now, if you see here, almost all consumers, 80%, 4 out of 5 consumers are really looking for a stamp duty to kind of head on early to their decision making on purchasing a house. But particularly in the housing segments, which are in the higher income groups, people earning more than 5 million, more than 50 lakhs, that is where the inclination for a stamp duty cut, and therefore taking a decision to commit to a property purchase was seen to be much higher compared to the lower income groups where, stamp duty did not come out to be a big reason. In fact, we saw this during 2020 and 2021, particularly in Mumbai region, where the premium properties worth more than 2 CR, were the ones which saw a much stronger sales momentum compared to the mid and lower segment, which is further reinforced by the survey that we conducted with these consumers, not limited to Mumbai, but across the country. Shift in home buyer preference towards under construction property. Clearly, we've seen in the last 4 years, consumers have come out in favor of under construction properties, which was not the case 4 years ago. After the experience of stalled and stuck projects, particularly in the NCR region, but across the country in the last cycle, consumers had turned away from under construction and early stage projects. While RERA gave some comfort, but it's particularly in the last 4 years, after consumers started to recognize that the nature of the ecosystem of supply side has improved materially, whether it is in terms of the balance sheet strength of developers or the execution capabilities. And that has given consumers a lot of confidence to commit to under construction properties. And in the survey, almost 81% of them remarked that they are actively considering under construction properties. Obviously, there's one more reason of a lack of ready inventory, but at the same time, consumers have clearly opened up. It's only the resale category which had very low interest, just about 2% consumers highlighting their inclination to commit to a resale properties. So the real estate market continues to remain on a strong trend. On the financing side also, it's not just limited to the banking and NBFC sector exposure, but even in the public markets, the real estate sector on the public markets, whether you look at the equity space, where the real estate indices have recorded outperformance not just in the last 3 or 5 years, but even on a last 10-year basis. So doing well, even on the public markets, which is the REIT segment. We have almost 90 million square feet of office REITs, which are listed now. In case of retail, it is about 9.6 million square feet of REITs, which are about 10% of the overall office and retail markets respectively. But the runway is huge, considering markets like the US have almost 250, 255 REITs, whereas India at about 4 or 5 REITs. Similarly, if you look at the private equity side, the private equity participation in the last couple of years dipped, particularly with the rise of interest rates in the US. But now, as the interest rate cycle has turned in the developed markets, which provide capital to the country, we've seen 2024, the first 9 months have already surpassed in terms of private equity investments. Almost $3.5 billion of investment has already come in. And with the sales momentum on most of the real estate asset classes, we project it to going up in the next year. So with all of this, clearly the real estate sector is on a strong trajectory. The scales are expected to go up. Consumers have remarked on their aspirations, and most of the supply side is able to comprehend accordingly, align products which suit the contemporary consumer requirements. So with this, we'll close the presentation, and then we'll move to the discussion with the group.
Thank you very much, Mr. Rathi. That was a very insightful presentation in keeping with the theme of BFSI Insight Summit. And it truly sets the stage for our panel discussion. We will also literally set the stage before we begin the discussion. Excellent takeaways over there. What is it that people want? The preference for apartments over independent houses.
We'll just take 2 minutes more, please. It was also very fascinating to see the difference between, what baby boomers want, the millennials want, and what Gen Zs want. And 70% is a pretty decent number even for Gen Zs to aspire for an apartment. I had thought it would be less. So that was quite interesting to know. Okay, thank you for waiting. Thank you for your patience again. May I now please invite our panelists. We'll begin with Mr. Ghulam Zia, Senior Executive Director at Knight Frank India. Welcome. Huge round of applause, please. Mr. T. Adhikari, MD and CEO, LIC Housing Finance. Mr. Ravi Subramanian, MD and CEO, Shriram Housing Finance. Mr. Girish Kauski, MD and CEO, PNB Housing Finance, and Mr. Deo Shankar Tripathi, Executive Vice Chairman, Aadhar Housing Finance. Welcome. And taking us through the discussion will be Business Standard Banking Editor, Mr. Manojit Shah. Please, Manojit. Over to you.
Thank you, Vinu. So, as we have seen from the Knight Frank report, home loan is the most preferred factor for buying a house. And who better to take the report forward with a stellar panel that we have with all the top housing finance companies of the country. A big round of applause for all the panelists. While the survey, the Knight Frank survey, is extremely interesting and insightful, and it says that aspirational buying is the key driver for home loan. But if you go deeper inside, there is another interesting facet, which says that properties below 50 lakh, which constituted 54% of the sales in 2018, has now account only for 28% in 2024 so far. At the same time, luxury market has witnessed a significant surge. Property prices above 1 crore and above has grown from 16% in 2018 to 43% in 2024 so far. So the main issue here is that, at a time when affordable housing is a policy statement from the government. So is the affordable housing story over? That is the big question we would like to know from the panelists. And we would like to start with Mr. Adhikari, the largest housing finance company in the country, the MD and CEO of LIC Housing Finance. Yes, Mr. Adhikari.
Yeah, thank you, Manojit. I think your question was basically on is the demand for affordable housing over? No, I don't think so. I don't think so. Well, if you study the Indian economy, it's only 10 to 15% is organized, almost 85 to 90% is unorganized. So the affordable segment is basically catering to this unorganized segment of society. So definitely I would not think so. I think so you pointed out to the report that the share fell down from 54% to somewhere around about 20%. I think reasons are twofold. One is a demand and supply issue. I believe there is a demand, but the supply is limited. And the reason for that basically, I would say, is I don't think many of the developer community is interested in getting into the affordable segment, right? It is low cost, definitely. It is away from the city centers or the urban centers. They are far mostly into the outskirts of cities where they are not very sure of a demand because of the livability conditions are not there. And developers, they are into a business. They want margins. I don't think right now the affordable segment or the affordable sector of housing is as margin intensive as, say, a semi-luxury segment or a luxury segment. And hence all our the builders and the developers are into the semi-luxury and luxury. We hear of, in the morning we were talking of projects in Gurgaon where 400 flats of each flat costing 100 crores are selling off like hotcakes. So any builder, any developer would like to go there where he can accomplish his probably yearly sales targets, yearly revenue targets, and daily profit targets in one project rather than get into the rigmarole of developing an affordable segment project where he does not have too much of margins. That is the reason I believe. Honestly, I believe that the demand for affordable is definitely there and will continue to be there in the years to come.
LIC housing will be continue to be there.
Yes, we are there, we were there, and we will definitely like to increase our share in the affordable segment.
That's great to hear. But Mr. Zia, if I can come to you, do you agree with the fact that the supply constraints so far as affordable housing is concerned because margins are not there?
Bang on. I would go by that. And as Mr. Adhikari just explained, the reality is that the stocks are very limited and developers are not adding more. This is one sector, as we also spoke about, like if one project, as he gave the example, is giving you almost double the annual revenue target of that organization only on one project, then what case does it make to do 25 projects of 1,000 apartments each and continue to put so much of efforts to sell them? So the problem with affordable housing, while the high interest rates, etc., have had an impact on the demand side, but the impact on the supply side is much more than the impact on demand side. So my concern is that in times to come, when the PMAY 2 is giving lots of incentives for the lower end demand to be generated, I have a concern that in times to come, we will not see enough of supply. And that can have an impact. It's simple economics. That can have impact on the prices of affordable housing as well. Because in the last 4-5 years, no supply of affordable house come, no considerable amount of supply has come in affordable housing. So in times to come, the concern is very huge that the demand supply scenario may push the prices in affordable housing higher in next year and a half or two when PMAY 2 starts showing its result on ground.
Mr. Tripathi of Aadhar Housing is a company which is extremely focused on the affordable segment. So, Mr. Tripathi, how to solve this problem of affordable housing? What is your prescription?
Actually, first of all, I must be thankful to Mr. Ghulam Jia and his company Knight Frank. They brought a very insightful report. Last 4-5 years, you have been reading from 2022, that the higher segment growth is going up very high. We are all listening. But we must understand how many persons are taking the loan of 1 crore, 10 crore, 20 crore, 50 crore for buying a house. What is the addressable market that we have to see? In India, today, 95% housing loan requirement comes from economically weaker section and low-income group. And they can't afford a house beyond 25 lakh rupees or 30 lakh rupees. That's why Reserve Bank of India and Government of India has also kept the property price in metro as 45 lakhs for affordable housing and non-metro as 30 lakhs rupees. So we have to see the objective point of view. whether we serve the volume or we serve the value. From the housing market side and the economy side, if the more value is created, the credit growth happens. And housing always has a multiplier effect on employment. Housing always has a multiplier effect on the supporting the 250 industries and services sector. That is the economic part. Now coming the people part. When today also, the present report which says 64% home loan borrowers comprises below 25 lakhs. 24% is their contribution in the value and 64% in terms of number. The 1 crore and above which are telling, they are only 12 to 13% people who buy houses above 1 crore and above. For taking a home loan of 1 crore rupees, you need to have 25 lakh rupees minimum your annual income. How many people have 25 lakhs and above? So we should think where the country lives. We have got, today as on date, I don't go 2011 population, take tier 1, metro and tier 2. There the requirement will be 50 lakhs and 20 crore and 50 crore rupees, the housing. Now the tier 3, tier 4, tier 5 is also population from 5,000 to 10,000 population. All roadside small towns. They are fast developing. And if you go another report of State Bank of India of 2022, they have mentioned 32% requirement was in tier 3 and tier 4 for the housing. In 3 years' time, by 22, it has gone to 22%. Sorry, 36%. So that clearly indicates the requirement in tier 3, tier 4, tier 5 is fast improving. And that is the objective of a government of India. The government objective is to see the credit growth happens, employment is created, and the people get a reasonable dwelling unit in a community development area, instead of living in a one-room kitchen where 5 people are living. So my simple point is that the requirement of affordable housing has been there, is there, and it will continue for next 25 years. As the income grows, the quantum will increase. 30% cost of construction has gone up in last 4 or 5 years. The person who was taking loan below 15 lakh rupees now takes loan about 20 lakh rupees. Person who was taking loan of 25 lakh rupees will take loan of 30 lakh rupees. So that shift has happened. The only thing I am telling you, and I am telling second thing I tell you, is still the housing finance companies, they are serving loan below 25 lakh rupees to the extent of 42%. Whatever you have seen 24% from 2018, for 38% below 25 lakhs has come down to 24%. In terms of number, from 79%, only 64% has come in terms of volume. Banking system and the premium housing finance company, their huge shift happened for the high value segment of housing. The lower income segment has gone to the housing finance company. If people like me and other affordable housing finance companies say, still today my 25 lakhs and below disbursement is 85%. So my point is that, and there are about 65 affordable housing finance company. The affordable housing finance company is going to stay, and that's why the Prime Minister Housing for Scheme is launched.
Right.
Because the government believes if 37% today urbanization has to go 40% by 2030 and 50% by 2047, the U means that as urbanization moves, there will not be only 50 metros, 57 metros, there will not be only 100 cities, there will be almost about 500, 600 cities.
Right.
And that's why one Kotak report also mentioned that now housing is not confined in 8 top cities, it has gone to 200 and beyond cities. So please understand, their value will be not much. Today, again I'm telling you, 60% housing happens in the urban centers. But what about periphery? What about other areas? So affordable housing is there and it's going to stay.
Affordable housing is going to stay, that's what you are saying. Mr. Subramaniam, have you seen changes, significant changes in the ticket size, average ticket size, which supports the theory that the affordable housing story is sluggish?
I just would like to point out to one single glaring point in the Knight Frank study. The first slide said that in 2011, we had about 275,000 units sold. 2023, there were 325,000 units sold, which means in a period of 14 years, the number of units has gone from 275 to 325 only. So before we celebrate the real estate industry, let's understand that that is a growth rate of under 15% over a period of 14 years. The reason why it seems like a huge growth industry is not because of ticket size, but because of the fact that the value of properties has gone up significantly. Point number two is when you turn around and say that the contribution of under 25 lakhs was so much in 2011 or 14 and has gone up to 41% in 2024 or 23, you have to keep in mind that a lot of migration has actually happened because of the value increase, because it's become more expensive to own real estate in this country than what it was. Bandra used to be 10,000, 12,000 rupees in 2011. Bandra is now at 60,000 rupees a square feet, or maybe even more right now. So that's led to an increase in the larger value properties being sold. It'll be very interesting to see the same graph per square feet.
Right.
Right, in terms of how many square feet were actually sold in residential in 2011, how many got sold now. The story will be very different. What is an affordable unit in terms of square feet? If you plot that, you would find that that migration has not happened significantly. You still have affordable housing in demand in a segment of population. I agree with Tripathi ji completely. The reason why people are not buying affordable homes anymore is because they can't afford. That's the name. It's called affordable housing. It's no longer affordable. So if you really want to increase the sales of affordable housing, I think a lot has to be done by affordable housing finance companies, by banks. At this point in time, affordable housing finance companies are playing the role of banks. Banks do not fund self-employed individuals, period. There is no debate on that. A lot of affordable homes were in the past bought by self-employed.
I will come to the issue of banks, yes.
Okay.
But finish your point, yeah.
A lot of affordable homes were bought by self-employed earlier. Today, they don't have access to funds. How many self-employed are being funded by banks? Today, we fund 80% of our portfolio is self-employed. 60% of their portfolio is self-employed. A lot of PNB housing is self-employed. But you look at banks, you are a salaried with a salary slip, you'll get a loan from a bank. You're not a salaried, no salary slip, no income tax returns, only assessed income. No bank is willing to fund them. Where do they go? So you want them to buy a 25 lakh property or a 30 lakh property without a home loan. How are they going to buy?
Right, right. I will come to you. But Mr. Khoshgi, do you think we need to change the definition of affordable housing because there is so much price increase has happened?
I think we have to put things in context. Last 15 minutes, this entire panel is discussing about affordable housing. That is the importance, which is there, which the segment has gained. Now, always we talk about gap in demand supply in affordable segment. See, today if you look at the entire book built by affordable companies, it's little over 1 lakh crore out of 34 lakh crore. So what is the percentage? It's hardly anything. If you look at the potential, it is in terms of sheer value, it's about 40%. It's about 40%. Today, I think structurally for affordable segment, at least for next few years, we always say that developer participation is not there. That's true. It is not there because it's not viable. There are so many challenges. Today, look at the focus of government. Today, look at the focus of every single housing finance company. LIC Housing, big brother, they are now getting into affordable. PNB Housing, third largest, we are into affordable. Look at Bajaj, they are getting into affordable. Talk about any housing finance company today. They are getting into emerging, they are getting into affordable. They may call by different name, different segments, but this is the focus. Why is that? Because all the banks, they focus on super prime and prime. So market is huge, demand is huge, on the supply side, self-funded. When I say self-funded supply, it is even today, 80% of the affordable business is built based on a plot purchase and construction or purchase of independent house. Where is the problem in supply? The problem in supply is developers, they don't come out with affordable projects because there are 3-4 challenges. One, land cost is very high. Number two, the time taken from land acquisition to launch of the project, the period is quite long. Okay. Number three, the project itself at this point in time is not viable. And therefore, lot of developers, they don't want to get into affordable. But that is just 20%. Today, if you look at the entire country, barring top 2 cities only, Mumbai and maybe Delhi, rest of the markets, there is a good portion of affordable which all of us are doing. So there is affordable business in Bangalore, affordable business in Ahmedabad, Chennai, Hyderabad, you name the city. So there is a constraint on supply from a developer. I think it's a structural issue. Government has taken lot of initiatives. Today, if you look at, they've committed 10 lakh crore into housing. And only for PMAY, they've committed, wherein close to 1 crore customers will benefit over a period of next 5 years, which means 20 lakh customers every year will get subsidy. So, affordable, the demand, the question is not whether it is over. It has not even started.
It has not
even started.
Okay.
And as Mr. Tripathi said, as Ravi said, as all of us are seeing the pulse in the market, this industry will survive for next 50 years, not even 10, 20, 50 years. Today, the focus is not there, which is why there is a larger role which the housing finance companies have to play, and that is precisely the direction in which all of us, all the housing finance companies are getting into this segment.
Right. But Mr. Adhikari, policy prescription, he is highlighting some of the long gestation period, which is a roadblock for developers to go into affordable housing. So do you think from a policy perspective, there has to be certain steps that is to be taken to boost affordable housing?
Yes, definitely. I think if we really want affordable housing to take off in the sort of vis-a-vis the potential it has, yes, I believe all stakers have to put in corroborated efforts. It cannot be just the developer community or the lender community or the sort of borrower. I think all of us need to get together. Everybody has a role to play. As far as we, the lenders, are concerned, that yes, banks are not into the affordable segment at all, the self-employed segment at all. LIC HFL, my company, we are the biggest housing finance company. We were not there overtly, I would say. Covertly, we were there. But this year, we've taken a conscious step to get into that segment. We've launched a product very recently in the last month. But slowly but surely, that is the place where we want to be and where we need to be. That is there. As far as the government is concerned, yes, PMAY 2 is coming, is getting launched on the 14th of this month in Delhi.
Right.
All of us have been invited for the MOU handover ceremony. So officially it will be launched on the 14th. 1 lakh, as Girish said, 1 crore houses for the urban poor in the next 5 years. That is significantly going to boost the demand. The other part of it, I think the builder community, yes, we have been talking of a short supply of affordable projects. For that, yes, you need the builder community to come in as well, but they also need incentives. It takes a huge amount of a gestation period in developing a project is huge. That needs to come out. They have to think of innovative ways and methods. Something like prefabricated housing is something I read about, which China employed in a big way. I was seeing a sort of YouTube reel when China built a 10-storied hospital in 72 hours, I believe, using prefabricated. Then again, clearances from the various government and other agencies for various NOCs and all that. That needs to be speeded up, some single window thing. Some SOPs in the form of, I believe, affordable credit for the builders, affordable finance from the builders. through some government subsidies or something of that sort. Registration fees cut for affordable housing was one of the pointers pointed out by Ghulam Zia and his Knight Frank team. So I think all of us need to get together to create an ecosystem whereby this affordable segment takes off, because this is one segment, as Girish says, has just not taken off as yet. And I believe huge potentials are there. And I personally believe that the future of the housing finance industry, or at least the lender community, if I may say, it depends on the taking off of this affordable segment.
Right, right. So as Mr. Adhikari says, the PMAY 2.0 will be launched on 14th in Delhi. So Mr. Zia, do you think this can be a game changer? This can be a solution to the points that you have raised in your report, the buyer preference and all. Do you think that's an enabler?
Well, PMAY 1 has done a wonderful job. And one of the reasons, while earlier we were focusing only on developers' inability to come into affordable housing segment, but from policy framework, Pradhan Mantri Awas Yojana was also in kind of a transition. It was for last 2 years. The previous one had expired, the new one was taking shape. It has taken some time for us to reach this stage when PMAY 2 is now in front of us and it's about to be rolled out. So that is where the key impact of affordable housing will be felt. On the other side, when we talk about affordable housing, it obviously does not stop at only EWS. It also has a large part of MIG in it as well. When we are talking about 45 lakh as the limit for affordable housing, even in Mumbai, you have a sizable chunk of inventory which falls in that category. In fact, of the top 8 cities, Mumbai has the largest share of affordable housing sold. It will be very surprising for all of us to know. In Mumbai, we sell the maximum number of affordable units across the top 8 cities, much more than even in Bangalore or Pune. So it remains to be, we need to expand the horizon of affordable housing. It's not just about 5, 10 lakh or 20 lakh rupees apartments. It's even 45 plus and so on. Various developers' lobbies are lobbying and reaching out to MoHUA to increase this 45 lakh to a higher number, especially for the urban, Pradhan Mantri Awas Yojana, the urban side of it, the 1 crore that you're talking about. There are suggestions that it can be taken up to 65 lakh or 70 lakh, at least for cities like Mumbai, depending upon the ready reckoner values or circle rates, etc. So a lot of those things are in the making. So from the policy framework, of course, a lot is happening. So the future, as we are all talking about, while last couple of years and at least last 2 years have really not been too good for affordable housing, but going forward, things are very distinctly looking to be falling in place, with PMAY 2.0 playing a big role. And a lot of these policy framework changes are expected. We spoke about the stamp duty cuts, etc. But stamp duty cut, unfortunately, is a state subject. Every state will have to play that role. In Maharashtra, they did that immediately after COVID. In fact, the reason or one of the catalytic effect played by the stamp duty cut to bring the real estate sector circle back towards the higher end was stamp duty cut. While it is nominal, 1% or 2%, but it makes a huge impact. However, it was hijacked by the upper end, something which you would have seen in our report as well. Right. The stamp duty cuts are typically hijacked or used more by the upper end, because at 1 or 2% when you're buying a 50 crore apartment is a huge number. You can buy your next Lamborghini out of that 1 or 2% the cut of stamp duty that you have. But the same thing for a lower end house, when you have a 5 to 10 lakh rupee of house, that 1% or 2% can barely afford them a washing machine or a sofa set. So it doesn't make much of a difference on affordable housing as far as the stamp duty cut is concerned. As I said, it is normally hijacked by the upper end. But there are a lot of these impactful statements that will come as PMAY 2.0 is rolling out, and various state governments are doing their bit to improve affordable housing. So as all of them saying, affordable housing story is now building up. We have a long way to go.
Right. But Mr. Tripathi, do you see significant benefits from PMAY 2.0 as compared to the previous one?
Yeah, I just add what Mr. Jia has said. One is on the policy side, I tell you. 2.0 scheme is a much better version. PMY 1.0 was it. They found what were the mistakes and what was required. 2.0 scheme is very thoughtful scheme. One, the subsidy amount of 1. There are 4 versions of it. One is the beneficiary-led construction. That was earlier also, it continues. Why I am telling you why affordable housing will exist? Because 60% houses are self-constructed, which are not in the reckoning of any research. That is a very unfortunate or fortunate thing you can say. Across the country, even in Bangalore also self-construction takes place, that they count. But what happens in tier 4, tier 5, tier 3 city, nobody counts that. That's one part. Second thing, beneficiary-led construction is one. There they are giving subsidy amount 2.25, Government of India is giving 25,000 lakhs, state government is giving. Second is more important, what Ms. Jia mentioned, supply side is almost negligible in affordable housing. So for affordable housing in partnership, last time the government gave developer full benefit of the tax rate during the period of construction, 5 years, which this is now existing now, no more existing. What government has done, they have advised the state government, as he mentioned, it is a state subject. One action they have to take by December 2024, they have to ensure stamp duty is brought below 1% for economically weaker section and LIG income group. That is one. Second, they said that developers should be given, all these affordable housing finance developers, AHP, their subsidy will be again 2.25 lakhs with the state government, central government. But they said that by June 25, the conversion, what happens from non-agriculture to agriculture are so much, that should happen. Conversion charges should be waived. The other charges which they are doing, they should be waived. They should have in their development plan earmark the land for affordable housing, because what happens if somebody takes a house in Berar, he works in Bandra, he cannot commute properly. The house has to be here only. The government wants there should be a zoning should happen so that there should be proper land available in the next development plan. This is the instruction for all state governments. Some may follow, some may not. So a lot of policy measure government. Second thing what government is going to do in next week only, 45 lakh rupees construction of house was having lowest GST of 1%. They are going to increase to 55 lakh rupees in next GST council meeting. It is already recommended by Council of Ministers. The affordable housing amount, which I think we have been talking and deliberating, what was 10 lakhs about 5 years back has gone to 15 lakhs. Probably it will keep on evolving as the cost of construction goes up, people's income goes up. Tomorrow affordable housing can be 50 lakhs also. The government has stuck up 25 lakh rupees is the loan amount, income level up to 9 lakh rupees for MIG, 6 lakh rupees for LIG, 3 lakh rupees for EWS. Actually, the income level should be revised because this was done 2015 and the inflation index has not been given. Probably government may revise it. Government still feels that there are large number of people, they require up to 25 lakhs. And in affordable housing in partnership, there is a mandate that they may have small houses, low income houses, higher houses, but 25% of inventory has to be for economically weaker section. That is also a mandate. So the third scheme is interest subsidy, what we have been talking. The subsidy now will be given in 5 years. Earlier subsidy was to be given immediately after disbursement, and the loan account was, the principal amount get reduced and the repayment was getting reduced. Now subsidy 36,000 will be given every year, and therefore there will be a 5 years lock-in, so that many dubious developer of a small value, they were constructing house, taking proxy customer, getting loan done, and the subsidy amount once comes, they were closing the account. So 5 years before he closes the account, subsidy he will not be paid. So many measures government have taken to ensure that the first time user only get the benefit, not the proxy customers.
That's a very interesting point. But now coming specifically to the housing finance companies, there are a whole lot of regulation which has been announced over the last few years. Regulations have of course been tightened both for NBFCs as well as the HFCs in particular. Mr. Subramaniam, for example, one of the regulations says that which does not allow HFCs to charge interest rate till the check is handed over to the developer, which can only be done after certain things like the sale deed agreement, which of course hit the profitability. So, but do you think these steps are good for the health of the sector overall, even if there are short-term pains?
Look, we can debate this till the cows come home. Okay, but the point is that anything which is eventually good for the consumer will eventually translate to be good for the industry. Anything which is right to do is always good for the industry. And I think this is not only the affordable housing finance companies or the housing finance companies, but it's the entire NBFC sector and some banks as well, which actually were handing over the checks to the customer late, but starting to charge interest rate much before.
Right.
Now, there was a reason for that. We can always debate the reasons. Normally, when it's a housing loan, you're supposed to cut the check has to go into the agreement, so you have committed funds, so you start charging interest rate, etc. But the regulations were a bit unclear earlier. Now that the regulations have been clarified, every single affordable housing finance company, NBFC and bank now follows that. So to that extent, it's not something which is specific to the HFC sector. I would personally think that there are no regulations per se which are detrimental to the affordable housing finance company compared to a regular HFC or an NBFC. I think, if at all, affordable housing finance companies get a little bit of a benefit, because now if you look at the way the new NHB MD has been articulate about the support to housing finance companies, I think it's commendable. Now, he's gone on record saying that if somebody is giving out loans of 80 lakhs and 90 lakhs and 1 crore, why should they get refinanced from NHB? So he's actually moving towards a regime where the affordable housing finance companies get the support. The larger challenge for me, particularly if you look at it, where I need support from the regulation, where all the affordable housing finance companies need support from the regulation, is the fact that, and I've been saying this at every forum, is the fact that prepayment penalty, okay, is a bit of a sore point for us. Because what happens, I give out a loan at 12% largely because there's a certain amount of risk enough in taking on a first-time borrower. I run the customer for 12 months, 8, 9 months, 10 months, 12 months, season the customer, help him build a credit score. The moment the credit score is built, the moment the customer has shown an intent to pay, maybe one of those prime for housing finance companies or the larger housing finance companies or banks take the customer over. So in the process, my costs of operation go up because I build a customer, I can't keep him. Now that, if I'm able to impress on the government and the regulators to at least look at a 2 to 3 year window where I hold on to the customer, or the customer pays a certain prepayment penalty if he needs the benefit of a better house rate, I think that should be allowed. But so apart from that, there is nothing.
So the menace is created by the DSAs.
Sorry?
The menace is created by the DSAs.
No, it is not. To the contrary, if you look at it, the menace is not created by the DSAs. You need, it's just that there are so many players in the industry who are chasing the same customer. Why? Go after new customers. There are 30 lakh of houses being sold every year. Go after those customers and go after those loans. Why? Right. Come to a credit-tested customer and make life miserable. If you want to make life miserable, pay me my fees and go. I incur costs in underwriting the customer and taking him on board. And I don't recover my costs for the first year and a half.
I understand. That's a very valid point you're raising. What happens is that a new customer, within 6 months, 8 months, they just change to a different institution just because of 25 basis point lower interest rates. And so it's a losing proposition. But Mr. Khoshgi, how do you think this problem could be solved? That, just because, particularly from banks generally offer a finer rate as compared to HFCs.
I'm not very sure whether I have answer for this or not, but I think very clearly there are two things which I can talk about. So when we talk about interest subsidy scheme, which government has announced, it's a very good scheme. It says that close to 1 crore customers will get the benefit of subsidy over a period of next 5 years, which means 20 lakh customers every year, which is quite a lot. considering today the company is focusing on this segment. That's number one. So here what happens, there are two conditions, important conditions. One, the customer should not be delinquent. Once customer is delinquent, customer will not get subsidy. Because subsidy is paid every year for 5 years. So it's not one time, number one. Number two, till the customer gets the last tranche of subsidy, which is from today till 5 years, customer cannot switch. What is happening today is that, as Ravi rightly said, we put lot of effort, we onboard the customer, let's say at 12% or 11.5%, after 1 year's time, customer switches because customer is getting a slightly lower rate. Now this issue is solved under PMAY because for 5 years, customer cannot switch because customer is getting the benefit. Housing finance companies have put in the effort. So the book remains for 5 years. Otherwise today, the average loan on book for affordable companies is about 3.5 years. Number one. Number two, I think this is more to do with the entity per se. For example, you look at PNB Housing. Today we have 3 segments out of 4 segments. Super prime, prime, emerging, and affordable. Now affordable, I take a higher risk, charge slightly higher. When the customer is ripe for a switch, I have another segment where I can internally switch from affordable to emerging. Emerging rates are slightly higher than prime, lower than affordable. From emerging to prime. And eventually it will go on rest with any bank. So one is internal solution. Second is structurally, I think PMAY 2 has addressed this to a large extent. I think we have to look for some more. Going forward, if there is a regulation which says that because the primary motive of government, which is stated, declared, told multiple times, is to promote housing in the EWS lower and middle income group, which is why all this focus from government is toward this segment. A, B, all the housing finance companies eventually will move to emerging and affordable kind of segments. If there is something which comes in saying that for 2 years, customer is locked till customer switches, it's going to help.
Mr. Adhikari, is stickiness is also an issue with you? Did you see customers switching very soon because of other...
Yeah, this is a problem all over the entire industry. And I think, honestly speaking, we ourselves are responsible. We are all shooting each other in the foot and feeling great about it. But
that's
yeah,
that's
a sad part of it, and we'll have to live with it. Yes, as Girish said, in PMAY 2, the government has taken steps to ensure this switching does not happen. And maybe the regulator also needs to come in that, as Ravi said, that there are onboarding costs. And right now, if a customer switches, I cannot charge him any prepayment penalty or anything of that sort, which is slightly unfair on housing finance companies. I believe the regulator needs to have a relook at that. And if it wants to stop book transfers or balance transfers, probably the HFC which has onboarded the customer needs to be reimbursed its cost of onboarding. So that is all. Otherwise, I believe it is going to stay until and unless something serious happens on the regulatory front or otherwise. Yes, it's a part of it, and we'll have to live with it, I believe.
Right. We are running out of time.
I will take 1 minute just to add in that what all my 3 friends have said. PMY, of course, the business BT out by anybody is now ruled out because 5 years lock-in is there. If business transfer happens, then subsidy we will not get. The business transfer, that is from one company to other company, one bank to other camp, is a prevalent feature in majority of the cases which are DSA sourced or even sometimes customer. It happens for 3 reasons, Ravi also mentioned. If for interest rate reduction it happened, it's a fair thing, it is the customer's choice, which regulator also permits. Regulator also likes it, customer should have freedom. There are 2 other reasons which are cause of that. One is the top-up loan. I am not comfortable to give top-up loan to my 1-year-old customer by revaluing the property. Customer wants to have some additional loan on that. That is one situation. Second situation, the customer's account is in distress with us. He is finding to service the installment and he requests me for extending the loan period.
Right.
If I extend loan period,
It becomes
account
NPA.
becomes restructured in my hand. if the same account goes to other bank or other company, he gets top-up loan also and he gets elongated repayment schedule. So that account is not, it is a restructure. It is regulatory circumvention. Actually, this somehow has missed out from the eyes of regulator. If a customer, I cannot restructure by increasing the repayment period for a genuine need of having the income loss or some income reduction, I cannot restructure. He can restructure, X can restructure. This is regulatory circumvention. So if business transfer may be encouraged or hugely encouraged for the interest reduction, no problem. But for other two regions, there should be some check.
That is a serious issue,
if the
yes.
top-up loan tenor is capped at the residual tenor with the original lender, I think a large part of the problem will get solved.
Right. No, but it's a serious issue that if I go and tell my bank or HFC to restructure the loan, they have to incur higher provision. But once I switch, there is no such requirement for the so I think that's a very serious issue which you raised. Since we are running out of time, one last point I would like to ask, which was also highlighted in the Knight Frank report, interest rates, they also play a role in generating demand for housing loans. Do you think the interest rates in India are set to turn? That is the expectation. Globally, it's already turning. Do you think that can boost demand for housing loans, particularly affordable?
The gentlemen sitting over here are experts in the home loan interest rate movements, etc. From a development or from a demand perspective, it's actually given that if the home loan rates are coming down, the transaction numbers will shoot up. It's something which we have seen time and again and again. So it's a no-brainer. Of course, we are expecting the home loan interest rates to come down because the worst hit is the affordable market. The upper end of the sales are typically happening on the wealth creations, etc. Don't need so much of a home loan. It's only the lowermost end of the society. For buying home, they need home loan interest subsidies and they need affordable, I won't call it cheaper, affordable home loans. And that's something which is also one of the reasons why for last 2-3 years, the lowest end of the market from demand side has been worst hit. So with the change of cycle, when the home loan interest rates start coming down, definitely affordable housing will be the biggest beneficiary of that.
Affordable housing will be the biggest beneficiary, not so much the luxury segment, because for them 25 basis point, 50 basis point rate cut does not matter. Is that the view, Mr. Subramaniam?
I broadly agree with Mr. Jia, but you see, every 3 years the interest rate movement happens. Last 50 years, you see, 3 to 4 years it happens. And I personally feel the interest rate is inelastic to the demand of the housing. Lower interest rate only creates a good feel. I should take house because interest rate has come down. After 3 years, if interest rates go by 2%, then what he will do? So what he says, the people who are at the fence, who are looking at the interest rate has come down, they get encouraged. Otherwise, for 25 lakh rupees loan, 1 or 2% interest rise does not increase the EMI so much. So if you have a need, you will take a house.
See, I would agree with Tripatiji, but I have a slightly contrary view to what Zia said. 1% drop in interest rate is 65 rupees on EMI.
Right.
Okay, so it's not much of an impact. If you drop interest rate by 2%, or 3%, 150, 200 rupees a lakh, doesn't make much of a difference. It's a good mood enhancer. So, acha interest rate kam wala le lo. The impact of that is on the loan ticket size. So, typically what happens is your eligibility for a higher loan goes up, if your interest rate comes down. And hence, anybody who can afford a 40 lakh loan can now afford a 43 lakh loan on the same EMI. I think that's where the whole equation moves. But the contrary to that is, if interest rate drop is a mood enhancer, suddenly demand goes up.
Right.
Okay, your property prices start going up. So the customer ends up losing a lot more through the increase in the property price than the gain that he gets on the interest rate drop. So the real demand booster is going to be if somebody figures out a way to reach out a 45 lakh property to the customer at 40 lakhs. I think that's a bigger demand booster than interest rates. Otherwise, look at last 4 years, interest rates have been going up. Now, where has the demand gone down for people like us? All of our disbursements are going up year on year, month on month, quarter on quarter. So it is not particularly important. Interest rates are derived.
A related issue is fixed rate home loans have vanished from the market. Do you think, Mr. Khoshgi, the interest rate cycle is coming down? It's time to relook at a fixed rate home loans?
I agree with what Mr. Tripathi said, what Ravi said. I think interest rate has to be stable. Generally, it is told when the interest rate goes up, the default rate would go up. Because when the interest rate goes up, obviously the burden on the existing set of customers who were appraised at X level of capability, when the rate goes up, they're supposed to pay higher than their capability, and therefore the default rate goes up. I think it is more to do with sentimental, whether the rate goes up or goes down by 1% or 2%. I think what is the key is that interest rate has to be stable. It can't, if the rate goes up from 8% to 13%, definitely default rate will go up. If the rate goes down from 13% to maybe 9%, obviously there'll be an impact, right? Yeah. I think it has to be stable. Because of the huge fluctuation in the interest rate market, a lot of companies have withdrawn from the fixed interest rate. Even today, some of the affordable companies, they do have a fixed rate option. In fact, now there is a regulation as well that we need to have that option. But the differential between the variable rate and the fixed rate is going to be quite substantial. If you remember, in the year 2000, I'm not very sure, I think 2 or 3, one foreign bank came out with a fixed rate of 6.95% fixed.
Right.
So when the variable was about 7.5% to 8%. Now, that was the first time we saw fixed rate in India. And that really impacted the portfolio because when the rate started going up, they couldn't change the fixed rate. And if they had to switch, there was a huge penalty. Because of the huge fluctuation in the interest rate market, a lot of companies, they're not so keen to sell under fix it unless the margin is, good enough to secure, their spreads.
Right. LIC Housing Finance, of course, is a fixed rate product. Do you see much traction on that?
No, we're not offering almost more than 99% is floating. We are also into the floating. Nobody's into the fixed rate thing. So no, honestly, I agree with all the others. I don't think interest rates have too much of a bearing, irrespective of what the repo rate is, been 6.5 for almost 2 years now. But then there is a demand for housing loan, and if you looked amongst the companies, a company like LIC HFL offering an affordable product at 11, somebody else offering an 11 affordable product at 16. Both are doing business, both are growing. So it's not so much as to what the rate of interest is. Yes, it's a feel-good factor. If interest rate drops, the customer feels good. Otherwise, there's a demand for housing loans at various rates of interest across the country, across geographies, depending on the type of customer there is. So I don't think it's too much of a thing. Yes, it's a feel-good factor. A general euphoria is there. Rates have come down. People feel good about it, and they decide to take this major investment decision of taking a housing loan.
Right. We have completed a lot of time. I will take just 1 or 2 questions from the audience. Can I see hands, please? Yes, sir. You're from the... Can someone pass the mic?
Thanks a lot for the insightful discussion.
Please introduce yourself and keep your question very short.
Sure. I am Professor Sridhar, founder of Grand Alliance for Management Excellence. I am from Chennai. How is the talent crunch you are managing when your business is expanding and a lot of rural branches are coming in, but the HR force, which is must for you, how you manage it, or what is the plan?
Anyone want to answer that? HR.
I think mortgage is a very simple industry. It's a simple product, simple industry. It is not complicated. It is not like, consumer durable or, some complicated. It's a very, very simple thing. It's only because of the demand-supply gap. We see that the salary levels of our employees go up because, again, there is, a lot of switch between one institution to another institution. Otherwise, it is not so difficult to manage. We need ordinary graduates. Even today, if you look at the front line, you talk about any company, whether it is, you ask Ravi, you ask Mr. Tripathi, even in PNB Housing, the front line, it is not those IIMs and chartered accountants. It is a simple, ordinary graduate. And we have so many graduates, we have so many unemployment challenges across the country. It is not difficult at all. It is a very simple industry. There is no challenge at the front line. But the attrition was very high. Even today it's very high. Attrition is high, it's only because of every company wants a trained resource. So somebody has worked for 1 year, okay, let me onboard so that right from day one, that person will start doing business. If somebody invests by hiring from campus, when I say campus, I'm talking about ordinary graduates, BCom, BA, BSc, or maybe BBA from the college, you train them, they will be better productive. They can give you better business. I think there are a lot of strategies which each company adopts. Our strategy, for example, is to try and hire from campus. So at least at the front end, so that they would stay with the company for a long time, the attrition would be quite lower, and therefore the HR cost.
Right. One last question I will take, yes.
Yeah. I'm Nagesh Alai. I'm a co-founder at a Gen AI tech company. My question was this: how do you explain the low yield, rental yield of 2 to 3% in the housing sector, when it is also seen as a growing sector where you are bound to get better returns? I mean, how do you explain this contradiction?
Okay. Basically, if you look at mortgage, it's a thin margin business. If you talk about the first 2-3 segments, it's thin margin business because it's a leverage business. This business is all about leverage. Typically, companies focusing on, let's say, super prime, prime and emerging, they operate on a leverage of 7 to 8 times. It's a thin margin business. So even if your NPS go up, let's say from 1% to 2%, I think the company will have huge stress on profitability. Within the mortgage segment, while we talk about affordable and emerging, these are high margin business. Whereas fair enough. I think he corrected me on the question. So basically today, if you see in India, 70% of the population is still, they have income levels of much below the desired levels. And when it comes to whether buying a property or renting, right, the yield on rental is very less. As you rightly said, it is not more than 2.5%, maybe max 3%. Commercial could be maybe 4 to 6%, depending on the location and the pocket within the given city. The aspiration of EWS, LIG, MIG is to own a property once in a lifetime. And most of these properties are either bought or constructed for self-occupying and not as an investment. And therefore, this takes over on the return. They look at, they get that comfort saying that I own a property, I bought a property where I can stay, my kids can stay, my generations to come can stay in their property, A. B, it is not for investment. So they're not looking at the return. Eventually, they'll make gain on the capital gain. Property would appreciate because typically properties would appreciate. So they make money on property appreciation, but the idea is not to sell, but it's for self-occupying. And that's the logic, what is driving. However, at the high end, for example, we spoke about 100 crores, 50 crores, 20 crores property, which is super prime segment. There, you will have customers buying second property, third property. There is the choice between which asset class. Can real estate give me a higher return in next 5 years, or equity, or maybe debt, or some other instrument?
Right. Thank you so much. We have completely run out of time. Sorry.
Let me spend a minute, since the question was more about yield, and you asked a reason why this yield is so low. Obviously, as he said, the appreciation has to be added up. So yield plus appreciation, on an average, if you're talking about 5 to 6% per annum kind of a property price appreciation, you're once again adding the two, are in the range of 7 to 8%, which is comparable to commercial asset class as well. So there's not much of a difference, only how do you look at, because in case of commercial properties, when the rental yields are high, the appreciations are not so much. So overall, any asset class in real estate, roughly about 8 to 9% yield is what you would look at.
Thank you. Thank you so much. I think it was a fascinating discussion. And the good thing that has come up is that affordable housing is here to stay. In fact, we are just at a starting point. Thank you so much, ladies and gentlemen. A big round of applause for all the panelists.
Thank you very much. Very, very interesting discussion. So much we've covered: affordable housing, interest rate, regulations, quite a bit. May I please request Manoj to present mementos to our guests, please? Thank you, everybody. We will meet here again at 3:15 for a panel discussion on NBFC. We will be having simultaneous discussions and conversations between the two halls. There is and what a critical role the non-banking financial companies play in reaching unbanked and unserved or underserved communities of the country through innovative financial products and delivery mechanisms, and how they have fast-tracked financial inclusion, going where, you know, sometimes traditional banks aren't present. Among other things, providing financial support to the agricultural sector, to MSMEs, entrepreneurs, and also to the affordable housing sector. But there are challenges, of course, in terms of access to funding. There are asset quality concerns, there's competition from banks that they face, and of course there are other regulatory challenges as well. You know, we had the governor yesterday, and one of the questions was asked about the regulatory challenges that NBFCs face, and he said, he said of the 9,400 NBFCs that India has, action has been taken against only 4, and that is also because the regulator does not act in haste. It looks at not punitive but corrective, takes a non-punitive but corrective approach. That said, there are challenges as there are opportunities, and NBFCs have been playing a critical role in financial inclusion, like I said, and it's an ongoing exercise, a mission even. And on that note, I would like to invite our panelists on stage. We have with us Mr. Sachindranath, Vice Chairman and Managing Director, Ugrow Capital. Sir, could you please join us? And we have Mr. Venkatesh N, Founder and MD, IIFL Samastha Finance. Welcome. And conducting the session, moderating it, is my colleague Monojit Shah, Business Standard, Banking Editor. Monojit, could I request you to please come on stage? Over to you.
Thank you, Vinu. Very good afternoon to all the panelists and the audience here. So the topic for discussion is reaching the last mile. Now, in a country like India, which is as vast as India, the banking sector, the commercial banks are not sufficient enough to reach every nook and corner of the country. That is something is done, that is exactly the same thing which has been done by the NBFCs reaching the last mile. But the growth of NBFCs in the last few years have been quite significant. In the last 10 years, according to the Reserve Bank of India data, the total credit extended by NBFCs in 2013 was 1/6 of the total banking assets, which has went up to 1/4 by the end of 2023. So there is a significant growth by the NBFCs, particularly in the recent years. And NBFCs has emerged as a preferred option for numerous underserved sectors, particularly small businesses and household, because these players have went to areas where traditional banks could not go. At the same time, the regulator is aware of the rapid growth by the NBFCs, and that is the reason why there's a interaction, engagement at frequent intervals with the sector players. There are certain risks that has emerged in the recent times. But before going to those, I'd like to ask both the panelists their opening remarks on how challenging it is to serve the last mile. So we can start with Mr. Sachindranath.
Thanks, Monojit, and thanks for inviting us for this. First and foremost, I think so there is a misnomer. Generally, it is said that NBFC has better last mile reach. Actually, it is not true. NBFCs can't match banking sectors, reach into the markets. State Bank of India's branch network, big public sector, private sector's branch network is, almost multiplier of all NBFCs put together. So for some reason, we just unnecessarily give too much of credit that it is NBFC which is serving the last mile reach because they have better reach. They don't have better reach. Actually, it is a function of, and it is because either you can call legacy versus new generation, or you can call some favor of customization. It is our NBFCs generally of ability to assess a customer differently and provide a credit solution is what differentiate NBFCs from the banking. So it is not that we have better reach, it is that we are better, equipped to adapt to newer things. And this also may be the case that because banking is considered to be more fiduciary because they hold public deposit, and that's why they become more risk averse. That's the way regulator also want to that. That's their power of innovation and do new things is constrained, versus NBFC being wholesale funded institution can do that better. Think of this way, biryani actually you can go in Hyderabad and also eat biryani. It is customized to your taste. And now there is biryani by kilo, which is actually, populated and you can get it at home with the same taste. So think of a big bank is a Hyderabad biryani, which you have to go to that, restaurant. He will come, take your order, customized to your choice, versus the NBFC is biryani by kilo, which you can order any time on an app and it get to you.
So do you think that, your microfinance institutions, you do reach to the last mile? So how challenging is it for you?
In terms of, I slightly differ from what Sachindranath had to say in terms of reaching out. If you look at our operations, which is spread across length and breadth of the country, we do have really remote branches where still the banking is still not actually reached out to them. But from when we started, if you look at our journey from 2008, how it has panned out from, and the ecosystem which is created by, you can say, getting them accounts. With that, Jandan accounts has helped a lot in terms of many of them have become bankable, though they don't have access to the banks, but they do have banking accounts. Then with, if you look at Aadhaar coming in, and it's also helped us in the eKYC bit of it. So, the ecosystem in terms of how the NBFCs have used this also has been quite remarkable in terms of thing. And in that way, we were able to reach out to very inner pockets of thing where banks have not been able to reach out. And definitely there are a couple of other things which we need to really work on, especially we are predominantly a microfinance institution. Our lending model is really a cookie cut paste model. And we don't have real assessment of income, which we have to rely mostly on what the customer says and how do we assess it. But the important aspects of it is as we get into graduating these customers into higher ticket size of loans, the income assessment with undocumented income is becoming a challenge. And also we are only covering the credit side of the business, credit side of the requirement of the customer. But if you look at, there's a lot of requirement in terms of the savings, remittances, and a lot of other things which can be covered on. So yeah, last mile has definitely improved in the span of time of 10 to 15 years, but there's still a lot of opportunities to move up.
Technology is an enabler to reach the last mile?
Yeah, definitely. If you look at, as I mentioned, that a lot of things have gotten into place, but all of us are rushing into technologies into thing, but we are settled. Still people are not settling down with what's an app thing for the right use. So as we figure, on the credit side of it, actually, I just want to re-emphasize on income assessment, which is a critical thing, which today when, as a sector, we are slightly into a turbulent phase, we can look at it, we can go back and look at it that we have, in many of the cases, we wouldn't have done proper income assessment of customers, which we find many of them being little over-leveraged. So, with this aspect of it, if we can look at technology over a period of time where we can use AI and ML, we could see some usage.
Some usages. Mr. Sachindranath, do you also face this issue of income assessment? Do you give loans to first-time borrowers?
We don't give loan to first-time borrowers, unfortunately. Because, sorry, you look, India lack in large MSME financing institution. Actually, I was just with regulators just coming prior to over here, and I asked this question that, do you know that only two dedicated MSME financing institution is, one is UGRO, other is SEDBI. There is no other, NBFC you will find which is 100% dedicated to MSME financing. Only two of us are 100% dedicated.
MSMEs, yeah, right.
On the income assessment side, our belief is that MSME customer, which has been underserved for a very long period of time, for last 3 decades, it has not been served. That's why credit gap is 90 lakh crore. There is a transformational change happening in terms of a public good data infrastructure coming up, and there is a behavioral pattern change. So the behavioral pattern change, and that's what we say, you run a campaign called Kacha Chodo Pakka Pakdo, and second is MSME Acha, is that MSME customer is becoming more formal. His cash business is converting to more digital, which is GST plus banking plus bureau. And that's why the ability of assessing the cash flow and doing credit assessment is getting digitized with every passing day. So you combine that with human skill set, you should be able to build a very large institution. So my belief is that that problem which exists for, say, microfinance, affordable housing finance, and we're very, so people call us as, alternative method of assessment. It's not true. We do real cash flow assessment because we take turnover data, we take, banking data, we pull bureau, and then we do credit analysis, and machine tells us credit worthiness of customer and how much he can afford.
Correct. Now, while we appreciate the fact that NBFCs and MSMEs, NBFCs and MFIs have gone to the last mile, they have innovated product, but a recent commentary from the Reserve Bank of India governor, it's worth noting. He's saying that some of the NBFCs are aggressively pursuing growth without building up sustainable business practices. He adds that chasing excessive return on their equity, the NBFCs. How do you see this statement? Is that a warning bell for NBFCs to slow down on the growth, to realize that there could be problems ahead, particularly for an NBFC like you, who are the MSME, who mainly give loans to the MSME sector?
So look, it is around 3.5 years back. Around 5 years back, when I was starting UGRO, it was in 2018 or 19, just after financial crisis, one of the another new entrant, which came from outside financial sector, and I was having a conversation. And his point to me was that people like you who come from banking, financial sector, don't really understand the customer behavior. Versus we who have come from purely technology background, just by changing or understanding the customer behavior can change the lending landscape and financial services landscape. My point was different. Look, when you have a marketplace, think of an Amazon. Now Amazon have product and a technology platform and a consumer. There's no third element to that. And Amazon doesn't pose any systematic risk. So for some period of time tomorrow, if Amazon shut down, people will not be able to buy from Amazon. Probably they'll go to next store and do it. Financial system, unfortunately, also have a third element, which is the money market system or the financial system. NBFCs borrow from the bank take money from deposit holder. Now, if you create, because you have, for whatever reason, whether greed, growth, rate, if you build excessive exuberance and you pose risk to the overall financial system, then there is a problem. Now, whether that is because there is a pressure of investor, because whatever maybe, or their management team, whether our governor also said about the, compensation structures of management teams in NBFC, all this put together, fact is, it is, if you have a small child and if you want that child to become healthy and become a big man, irrespective how much of vitamin injection you put him, he will grow only by his age. So financial system, people have to grow as they vintage and not grow disproportionately. Otherwise, you run the risk of dying. So that's what it is.
But do you also agree with the fact that the regulatory arbitrage between bank and NBFCs are narrowing? Or do you think there is a significant advantage still? Yet, of course, there are no CRR, SLR, but otherwise there are significant advantage to operate as an NBFC rather than a bank?
It depends. I think so. It depends who you talk to. So if you talk to an upper layer NBFC, probably the arbitrage, I won't term as an arbitrage, or the regulatory, difference is much narrower. If you go to a base layer NBFC, it is significantly improved. If you look at within the middle layer, if you are larger, then it's lesser. Otherwise, you still have it. I would still say that because between a bank and NBFC, because NBFC are wholesale funded, they have one more degree of supervision, which is the lender itself, and that's why regulator give them flexibility to do things the way they want to do it. And that is what regulator has been telling these banks who lend to the NBFC, that you are not doing good job to see who you should lend money to,
right.
And that's why reduce it. Versus banks have no such, bank has only RBI. Because you take money from deposit holder, and if you do too many riskier things, then the whole system can crash down. So I think so, over a period of time, once you reach a size, I think so 30, 40,000 odd crore, you have to be a bank. Otherwise you pose a very significant systematic risk to the whole system. And
that's a very interesting point you're making. You're saying that after particular size, NBFCs has to become banks because survival of that NBFC as a standalone with a book of 50,000 crore or something could be difficult.
So in past we have NBFCs which are 3,50,000 crore, then 3 lakh crore, then 2,71,000 crore, and so on and so forth. Right? That's in the past. Going forward, NBFCs can grow to 3 to 5 lakh crore. My general view is that the amount of interlinkages and systematic risk, either they have to be governed like a bank, then they will not survive, or they have to be converted into bank. I don't think the regulator or the industry has reached to that point of time, but my prediction is that it would go in that direction.
Right, thank you. Now I will come to the MFI sector very briefly. So just a bit of a background. So what happened a couple of years back is that, meanwhile, the MFI sector has grown very rapidly in the last few years. In fact, they have outpaced bank credit growth and emerged as the largest provider of credit with nearly 40% share in the microfinance segment. So within the microfinance segment, the microfinance institutions have the largest share of 40%, much higher than banks. But then what happened was 2 years back, earlier what was there was that RBI has capped the spread of MFIs around 12%. Now the spread has been removed 2 years back. I wanted to know from you, do you think that was a good decision to remove the spread cap from MFIs 2 years back?
Yeah, just to go back a little, post the Andhra crisis, which was in 2010, which hit the sector really badly, RBI constituted something called the Malagong Committee, and they came out with this recommendations of a margin cap. The larger NBFC MFIs, there was a new thing carved out called NBFC MFIs, and within that, the smaller ones were given a margin cap of 12%, and the larger ones were given a margin cap of 10%. Post that, if you look at it, many of the operating NBFC MFIs one of them went on to become a universal bank.
Right.
Then many of them went on to become a small finance bank.
Yes.
But the regulations was only curtailed only to the NBFC MFI sector. And most of the margin cap, everything was only applicable only to the NBFC MFI sector. So what came about in April 22 when RBI re-looked at the microfinance aspect of it, they thought people who are serving the sector should be all be bought under the same umbrella. That's the regulation which got changed a little.
Correct.
And since the other SFBs or universal banks did not have
that cap,
the cap, they thought NBFCs, MFIs also need not have that cap. See, if you look at it in terms of the margin caps, even at which we operate right now is almost similar to what we were operating in a regulated environment. So I don't see that, that aspect of it being a big change in terms of that. But one aspect of it, if you look at it, which the regulation had changed was any household with a 3 lakh income was Christian as a microfinance customer. And I think so some part of it, we as an industry also had some reading of it little wrong. If you look at it, the number of lenders for the customer, which was earlier fixed in before April 22, we went little, the number of lenders to certain sector, certain geographies increased. And that had spiraled this, and which we can see out what is playing out today in the sector.
Right.
But I mean, all of us have understood it. SRO, if you look at MFIN, what has addressed it very thing, and we have taken steps in terms of how we need to go forward with aspect to the thing. And even interest rates, we have gone about recalibrating it, and the whole thing we have revisited how things have to be looked at.
Yeah, of course, he was extremely candid, I must say. And the context was that recently, I think 15 days back, RBI has come down heavily on some of the MFIs and asked them not to lend. They have restricted lending because they were accused of charging higher interest rates to the end customers. But that apart, the other issue is the stress among the MFI borrowers. Generally, MFI borrowers come in the stress for 1 month, 2 months, they come out of the stress. But don't you think this time the stress has got a bit longer? It's lasted more than 6 months. And what could be a reason for this stress this time around?
Yeah, I mean, there have been multiple factors for this. We just can't point one aspect of it. If you look at it, it started, as you said, it's almost 6 months. See, if you look at it, the MFI sector, we cater to close to 65 to 70% as agri and agri-allied. Our customers are mostly into agri and agri. If you look at the heat wave was quite strong.
Correct.
There was some percentile effect of the heat wave. Then RBI had flagged off couple of geographies was getting overheated with the excessive lending, over-leveraged customers in certain geographies.
Which geographies?
Predominantly, it was pointed out with UP and Bihar.
Okay.
See, these geographies were predominantly picked up by RBI, and they spoke about stating that there was overheating. All of us took a very cautious approach. We started re-looking at what is happening and thing. And followed up with the guardrails, which the SRO had brought about, which also capped the number of lenders to the customer.
Right.
Right now, there was no capping of number of lenders to a customer. Right now, we have a capping of number of lenders is 4 lenders is the maximum cap.
Yeah.
So that also has played out a little bit. So, we see close to 10 to anywhere around 10% of our overall customers having borrowings from more than 4 lenders. So all these have contributed slightly, the stress has thing. But we are hopeful that, normally we do have, we have been used to something once in 2 years or 3 years. We had a demand-related stress, then we had a COVID-related stress. But this one is something which we look at more internally of what went wrong with us and how we have gone about our practices. I think so we are recalibrating ourselves. Things should fall in place in another couple of months.
That's an important point you are making. You think the stress which is there, couple of months, it could show signs of improvement.
That's right.
The rural distress or the K-shaped recovery that we talk about, Mr. Satyendranath, do you see stress in the MSME segment also? What has been your experience in the last few months?
I just wanted to quickly comment on this. And as an outsider, I don't deal with MFI as an industry. But I just want to say this. See, look, there is no premium anywhere, no longer, to build anything long-term. Everything has become short-term. Public market is very short-term oriented. Investors are short-term oriented. So as the management. And there is premium to deliver quick, good result. and be, financially benefit from that. It is what, in the context of what Governor also said. In MFI industry, COVID actually hit MFI industry very hard. And after COVID, people took all the write-off, everything has happened. That was, act of God. And after that, there was an absolute premium being paid because interest rate were deregulated, over leverage was provided. And industry, MFI industry has no reason to self-behave because market doesn't pay premium for self-behavior. So it is a reflection on all of us, capital market investors, us as together. So that's the broader, problem and being addressed. With respect to the, what you call stress in MSME industry, as you know that we publish every 6 months a report called MSME Sampark along with DNB. And, the whole campaign which we run MSME Achha hai, because generally within the banking sector for last decade or so, it has been presumed MSME is a weak customer segment. We only target customers, or our desired customer segment is customers which are between 15 lakh to 15 crore turnover. We have 1,30,000 customers in last 3 years. We pull 30,000 customer GST data every quarter and refresh back. And only one critical parameter we analyze that post our credit, whether the turnover has gone up or not. In last, 6 or 8 quarters, we are seeing within MSME, for this customer segment, we are seeing more resilience to come. Except in this quarter, we saw a 5% dip in the overall turnover data, especially in some segment of the market. So short answer is that as of today, we are not seeing the stress to which has been built up in personal loan, consumer and microfinance industry to go to micro and small enterprises. We go to a medium part of it, 50 crore to 200 crore turnover, that's a very different story altogether. But retail trade in tier 2, tier 3, tier 4 towns and small manufacturing are doing much better. They are still not reached pre-COVID level, by the way. So they are about to touch that in next 1 and 1.5 quarters.
Right. Mr. Venkatesh, post the deregulation of the SCAP, do you think MFIs have front-loaded their growth ambitions? That they went, earlier it was seen 1,000 crore was the kind of a thing. Now after that it became 10,000 crore. Everyone wanted to grow. Do you think front-loading growth was one of the main issue post the deregulation of the margin cap?
It can be, it's a two-part to it, because if you look at the larger entities which looked at the post-deregulations, everybody was mindful of in terms of what was their borrowing costs, and the formula which RBI had earlier in terms of that 10% margin cap was very much in their mind when they revisited the pricing for the customer. But the cost of borrowing for various entities, we have large, medium and small. All of them had various pricing entry barriers at the thing. And for them also the cost also varied. So in that way, quite a few of them had higher cost of lending to the customer. We can't deny that aspect of it, that it was not there. But that was restricted for people who are borrowing at a higher cost. So it was restricted to smaller entities and thing. But by and large, larger entities did follow a clear thing, because very early on, RBI, at least when they had meetings one-on-one with us, they were constantly looking at our pricing and how did we arrive at the pricing. It's just not that they were fine with whatever price we went on with the customers. So the smaller ones, given that their regulation is they would have gone a little haywire in the pricing.
But what are the, of course, for NBFC or NFI, the raw material comes from bank. You have to depend on bank funding. Not really?
I think so, it depends. So I always, it's my favorite, I say India में there are दो तरह के NBFCs हैं, एक लक्ष्मी जी से blessed है, एक सरस्वती से blessed है. So if you have a big parent which is a large Indian corporate, then you are blessed with Lakshmi ji. Then obviously bank is your primary source. Every bank to a large corporate or NBFC will lend in this, any amount of money. And there are people, professionals, who have set this up and blessed with more knowledge. They have no choice but to diversify,
Diversify, yeah.
And the source of diversity, we have a 10,000 crore of total asset size. 5,000 crore we have demonstrated in form of co-lending, and balance 5,000 odd crore besides our equity. Bank financing is only 40%. Every DFI in the world is a lender to us. Whole capital market is a lender to us. It might be a little bit of expensive, but you have to make a conscious and harder effort to have a diversified lending. For large corporate or NBFC, banks are the cheapest source and very easy to do that. But rest of the world, it is not easy. But there, if you work harder, there are alternative sources as well.
Have banks started reluctant post the recent stress in MFIs to fund MFIs?
I mean, a lot more questions asked. I mean, in terms of, for us, we have not seen that kind of a liquidity crunch or banks not completely shying away from us. But the problem is for us right now is deployment of funds. So, we are not back into the full steam of, given that all of us are recalibrating and figuring out what actually went wrong and figuring. So we have a fair sense of what has to be done and things. So the deployment of funds has been a little slower, but banks have really not shied away.
Deployment of funds have been a little slower. As you said that in 2-3 months, once the stress part is, then probably you will start grow once again. That's true. Right. Ugro Capital is a tech-based NBFC. A lot of technological support is there to support the business model. But at the same time, the regulator has highlighted credit risk from rule-based credit models. They said over-reliance on historical data or algorithms may lead to oversight or inaccuracies in credit assessment. How do you maintain a balance between the both?
We have no choice but to do it. We keep saying we are a Ferrari, at the back of which there is attached Balgadi. Right? Why I say that? Because when you have a 10,000 crore balance sheet and 50% of that it come in form of co-lending, and that co-lending comes from State Bank of India, Bank of Baroda, Central Bank. After 12 public sector banks, we deal with 6 public sector banks, all kind of traditional banks and large NBFC. They are yet not at the level of efficiency, whether you call data science or technology, where, what we are investing in. So there is no choice but to adjust wherein to use best of both worlds. We have to be as traditional as any conventional bank, but we also have to consistently convince them that some of our models actually work. We don't use credit model. Technology is not used for credit model. All of our investment is understanding the cash flow of the customer by using what available data is. When it comes to the credit, we are very conventional. So we have been able to create this balance by force. We have to deal with a bank, not just to borrow from them, but to co-lend with them, which means their understanding of a credit risk and the way they do it, and our has to be intermingled, and we have to do it jointly. So we are automatically balanced to that extent.
So co-lending has played a big role in the last few years.
For us, for sure, because as I said, there are 2 types of NBFC, one who can leverage on their balance sheet because of their parentage very easily. And for people like us, we cannot go beyond a 3.5-4 time leverage. We are very well capitalized. We have almost 2,800 crore of capital. But beyond 3.5-4 times, we can't get leverage. The only way to do that, and mindfully, co-lending is not just to increase the balance sheet size. Only way to benefit a small business customer in terms of the interest rate is to partner with a bank, because bank's cost of funding is much lower than what ours is. Our balance sheet cost of borrowing would not go down because who we are. But when we jointly lend, the benefit of the bank we can transfer to an end customer. So our growth is propelled because we have worked very, very hard to partner with this bank and bring the bank system to our end customer. So a lot of people ask me this question, what's your long-term vision? Would you become a bank? I said, बैंक तो हमारे पास ही है ना, अभी 10 बैंक के साथ हम मिलके काम कर रहे हैं, तो becoming your own bank is of no meaning, ना, because bank, the power of the bank is with us as long as we work with them continuously.
Right. Now, one question I would like to ask you very straight. what do you think a reasonable level of spread that an MFI can maintain or ROE?
The reasonable level of spread, if you look at it, see again, if you look at in this 3-4 months, our credit costs have spiraled up. Again, during COVID, we had, really high credit costs. So, on an average, if you look at it, pre-COVID, the credit costs were very around sub 1% kind of a thing. But right now, it's hovering anywhere between 3.5–4%.
Right, right.
So given that presently, if your cost of borrowings is at around 10.5 kind of a level, and we have close to, there's an OPEX which, because if you look at our, the model at which we operate.
Operating cost is high.
Operating cost is high because we, be it a monthly meeting for our customers, we do the joint liability group model of lending, where our field force needs to meet the customer either on a monthly or a fortnightly or a weekly basis, depending upon her repayment pattern. So the cost of operation is quite high. So, you fix a ROE, and work on it actually. So right now, if you look at, most of us are operating anywhere, the larger ones at least operate anywhere between 21 to 24% right now.
No, there are some MFIs who operate on a 30%, 32% ROE. So that is where I think the regulator comes in, isn't it?
Yeah, that's the thing again, because as he was pointing out, either you need to play a good handshake model with the banks and do a co-lending model with the banks, because definitely when you don't have access to low-cost funds, you need to make sure that you play along and make sure that you're able to get the increase your existing footprint with the help of the banks. But it's difficult to operate at such high margins, and definitely you will catch the eyes of the regulator.
But the larger point what I was trying to understand is that, do you think the deregulation of the caps have made the MFIs more disciplined? Is that the sense?
No, but as you clearly asked, what is your ROE, what is your ROE? So when the regulator speaks to us also, they are asking us very in-depth thing of how do we really arrive at our cost of lending.
Correct.
So that's, then it's almost like we can also present it clearly to everybody in the public domain, stating that this is it's all out in the public domain.
Right.
So, I think so that's somewhere it's going to settle down.
Okay.
Definitely post the regulation, there was a sudden spurt of maybe pricing little aggressively. I think so now it's going to settle down.
Both pricing and growth.
Yeah.
Yeah. Mr. Satyendranath, you talked about, after becoming a certain level of assets, certain level of balance sheet, an NBFC should turn to a bank. So, but what is your roadmap? A small finance bank or a universal bank after attaining a certain scale?
That was not an advice that they should turn to a bank. What I was saying that I think so where finally regulation would evolve to that once you attain certain size, either you grow not disproportionately, you pose a very serious systematic threat to the overall financial ecosystem, because interlinkages are very strong. If you are a 50,000 crore NBFC and your bank borrowing is 25,000 odd crore, something happens to you, 2-3 banks would go down. And obviously you don't want in our country another yes bank happening, because it would just disrupt overall economic growth of our country. You don't want
that. That is the case now. Even if the larger NBFCs, their bank funding is 40% and more.
Absolutely. So that's what I'm saying. What has happened in the past has happened in the past. You can't unwind it. Going forward, at certain size, there is more solution need to be done. Either institutional funding solution or, conversion into bank. Something has to be done. We don't know the answer of that. As far as us is concerned, we are still, few years away from that. I still continue to believe that, NBFC as an institution have more power to innovate, and that's why they should continue with that. We have intermingled, a traditional model of balance sheet-based leverage business versus a co-lending business. So we said the benefit of the bank should not necessarily can come to you by becoming a bank, by deeply integrating and partnering with the bank and get the same benefit. And if you run this, that's why we are almost 50% of off-balance sheet asset, highest in the industry, right? On an average, people are at 15, 20%. If you run that consistently and you keep good governance, I think so you can probably grow much larger. That is one point. Second is that I think so it's not about the interest rate cap. As I was saying, top 30 banks together in India at an ROA of 1.5%, but ROE, because they are leverage institution, ROEs are very strong. There are NBFC which are at 8 to 9% ROA and some are at 2% ROA. I think so it is excessive return on asset is what need to be monitored. And this excessive premium which people pay on high ROA business had to be curbed, and that would settle most of the thing. Financial institutions.
So are you suggesting Lakshman Rekha provided,
self-regulation
by RBI?
Yeah. I think so you hit 4.5%, and if you grow at 30% and you are leveraged reasonably, any investor would make 20% return if you stay for 3.5 years. And that is a very good stable return for any form of investor, be public market, private equity, or so that. So this, if you go hit 7-8% ROA and then you say this is the model to follow, you are creating a lot of disturbances in the customer ecosystem. And that's why I think so this time, I don't know whether it's right or wrong, I was surprised that, MFI SRO said, but I don't know if it's formal or not, that all microfinance institutions should target 4% return on asset and not beyond that. So I don't know whether it's an advisory which is formal or not, but I think so rather than they targeting interest rate, they targeted the ROA.
ROA.
Yeah, that's the way they have come.
What is the roadmap for MFIs? Do you think, there are many MFIs which has turned into small finance bank. So as a business model, the regulator is pretty okay with the MFI business model. They have given one MFI a direct universal bank license. So do you think converting into an SFB is the road ahead for an MFI?
See, it's not necessary that we convert into an SFB or something. But see, what's happening is we have a catering to customers with a 3 lakh income household. So we do have graduating customers who are all crossing the 3 lakh household limit. So these customers have grown with us over a period of time. So we have been in this space for more than 15 years, but we have seen many of these customers working with us for more than 5-6 years. The only thing which I think so we would like to get go ahead from the regulator in the sense is us to look at operating in different segments of the income household. So right now, below anything household income of less than 3 lakhs is positioned as a microfinance loan. So we do have an expertise where 3 to 6 lakhs. We do have a geography play. If we are operating in the geography, we can cater, we can create more products. In-house, we have already done it. So we have close to around 20% of our book in doing with non-microfinance products. Right. So when I'm saying non-microfinance, these are not in the JLG format. So we do have a micro lab, we do have unsecured business loans, we do have dairy cattle loans. So we need to expand that kind of a thing because the requirement has to be very specific and really targeted towards what's the income generation towards. And we have a proper assessment of the income using the undocumented income. Today, most of our customers don't have a clear documented income.
Yeah.
So when we look at it, when we are looking at these graduating customers, we really look at the undocumented income. We have seen them, the credit history over a period of time, so we can have other product offerings. So this expansion of product offerings from MFIs could help.
So conversion into a bank is not really, you are not excited about it?
Yeah, not really.
Too much regulations.
Yeah, too much of regulations. Yeah, we have also seen how the other SFBs have played out. For us also, we have, if at all we can look at an SFB, we have some more time to go.
Correct.
But in the near-time future, we are thinking that we should expand our product offerings to our present set of customers and also have more product offerings because we are operating in a certain geography. We should have a different product offerings.
Right. I have one more question, then I will open up for questions. I will take a few questions. How do you see NBFCs, NBFC MFIs offering non-financial products. There are many NBFCs and MFIs, they offer, say, solar lamps, lanterns, bicycles, they just sell. So that's a new trend which is catching up. How do you see that?
Regulation require our 50% of our income to come from financial assets, right? So we can hold only license till the time predominantly our income is financial income, not other way around. We cap our co-lending to 50% just primarily because of this reason, because otherwise, it will become you lose the license. As long as for MSME financing, it comes we tried experimenting. If you are adding value to a customer for his life cycle to improve, you should do it. So if we are an MSME financing and for a certain segment of the market, if we can bring providers of service or product to our customer, which can improve their working capital cycle, we should do it at size and scale. And if we get some reward for that effort, we should get it. But primarily financial institutions, if they are banking and credit institutions, should focus on credit and not too many exotic thing around that, because then you can lose sight of balance sheet risk, is my personal view.
Right. Mr. Venkatesh, do you offer non-financial products? And how is the response, if so?
Yeah, I mean, just to add on what Sachindranath said, yeah, definitely, if it is augmenting the income generation, we do provide. That's the only thing which we have looked at when we are looking at giving thing. But otherwise, the customers, there's a credit link insurance which we sell.
Right.
And
that's still a financial product.
That's still a financial product, but non-financial product is only what, but the overall, if you look at it, it's less than 2-3% of our overall customer base.
Less than 2-3% of the. I will take a few questions. So can you please raise your hands, introduce yourself, and request you to make the question short because we are running out of time. Yes, gentleman from here. Can you please give him the mic?
We'll be able to hear it.
Please use the mic. Please use the mic.
My name is Abhishek. My question is to you, Sachinda. So when you mentioned that NBFC is having return on assets more than 8%, so do you mean that any NBFC which is earning a return on asset of more than 7-8% needs to be monitored?
First and foremost, there is rarely, except one or two, which have that level of return on asset. I think so the market mean is around 3.5-4%. I am not saying that, we are a free country, we are a free economy, we are from socialists, we are becoming capitalists. Obviously, everyone has a right to earn as much as possible. But when you go beyond that, there is something which definitely need to be monitored. And second, as I said in the beginning, that at a 4% of return of asset with 5-6 times of leverage, you generate, roughly around 18-20% of return on equity. And if you grow at 25-odd%, which means you are self-funding yourself, that's a very good model. Large banks which have become large, ICICI and HDFC became large because they followed that model rigorously and continuously. But that was a time and era because that longevity approach used to be paid a premium. Right now, market has become short-sighted. So I'm not saying that it is not a good thing, but one has to be cautious that if you're trying to achieve that high ROA basis, operational efficiency and performance, great, but not by other means.
Because it also depends on the capital structure. Just another follow-up question, because see, there are a couple of names like Bajaj Finance obviously has a return on asset of not more than 4.5%. But say for a company like 5-Star Business Finance, they have a return on asset of close to 8.36%. There are a couple of housing finance companies in affordable housing segment which they have a return on asset of exceeding 7%. So I'm just curious if you are, hinting at that direction.
I'm not, and I won't comment on a public forum on a particular company.
Yeah, you cannot comment on company specific. We will have
general
some
sector.
Later on we can take it. Anyone else? Yeah. Please identify yourself and please make your question brief.
Yes. This is CA Pawan Kumar Darak. Actually, I am practicing chartered accountant. Sir, my question is, on one side, the cost of borrowing is very high. Again, even the banks are facing the problem in mobilizing the firm. Banks are issuing NCDs. So cost of borrowing is very high. Again, the operating cost is very high. And on the other hand, RBI is not comfortable with the charging high interest. So it will be difficult for few NBFCs to sustain. Or so what's your question?
You can answer it, yeah. Thank you.
See, I mean, I think so we are, with the intervention of technology and building more efficiency, I think so that's where we are getting pushed through. What RBI is looking at it is building in more efficiencies and better use of technology. And yeah, it's challenging at some point of time, but we need to make sure that we keep revisiting the model and see how we can do a better operation thing of us.
Thank you. Thank you so much. We have run completely out of time. And big round of applause for the panelists. They have been extremely candid and straightforward. Thank you so much. Thank you, sir.
Thank you very much, and thank you for the wonderful discussion. Manoj, may I please request you to, present some mementos to the panelists? Our next panel discussion will be here at 4:30. This will be on the future for the fintech industry, what the future holds. navigating the future of fintech, innovation, regulation, and growth. Sincere apologies for the delay. So India is among the fastest growing fintech markets in the world, and the future will of course offer significant expansion. There's also a view that as the demand for and acceptance of digital financial apps increases and traditional financial institutes start working with and partnering with fintechs, the lines between the two will blur. Now the question is, will that happen? What will be the growth drivers for the sector? What kind of innovation can we expect? And yes, how will the regulatory landscape play out in the midst of all of this? The Deputy Governor, RBI Deputy Governor earlier, in a session earlier during a fireside chat said that innovation must happen. There's no no question about that. And that he also said that the fintech landscape is much, much better now than it was a few years ago. And the self-regulation is the way forward. So we'll be speaking about all of this in this during this discussion, and I would now like to invite our panelists on stage, please. We have with us Mr. Akshay Mehrotra, co-founder and CEO of Vibe. A huge round of applause, please. Mr. Anurag Jain, founder and executive director, Credex. Mr. Riju Datta, co-founder, Cashfree. Mr. Srinath Sridharan, independent director, FACE, which stands for Fintech Association for Consumer Empowerment. It's an RBI recognized self-regulatory body. And we have Mr. Ujjwal Jain, CEO, Share.Market. Moderating the discussion is Business Standard Chief Content Editor, Mr. Suveen Sinha. Over to you, Suveen.
The music will stop now, right? Hi, thank you, Veenu, for that introduction. I'll just add a little bit of nuggets to what we already know about the gentleman here. One of them scored 331 out of 340 in GRE. I'm not going to name the persons, but one of you did. Okay. One of you is also founding member of the Digital Lenders Association of India, showing public spirit. One is apart from being the founder of Vibe, also the co-founder of Fintech Association for Consumer Empowerment, again, public spirit. And one of them who's still on the phone can type on the phone without looking at the screen. I saw this with my naked eye earlier today. He can already be talking to you, making eye contact, and he can keep typing on the phone at the same time. Big achievement. and he can write an entire newspaper column during his morning walk. Okay. So I will resume my seat there, but I have a couple of things to say. One is that my colleague Ajinkya had sent some talking points for all of you to consider. Now, Ajinkya is a very nice boy. I am less so. So let me be a little different from what Ajinkya had said. Let me also provoke you guys into thinking a little bit. What is fintech? In India, in this hall here today, if you say fintech, I bet most people will imagine digital payments. Okay? I don't know how good that thing is, because if something happens to digital payments, it will have some bearing on you, whether you are doing digital payments or not. Right? Is there an identity crisis to fintech? Okay, and how do you handle that? Let me have a physical bias. Can we start with Akshay?
So I think there is a little bit of bias when it comes to payments. I think a few months back we all came for GFF, and if you remember, GFF is mostly started for payments. There were more than 1.5 lakh people in the room, and we can see the audience here, so it changes. So that's for the impact of payments. But on the contrary, payment companies never make money. they're not profitable. And there's no concept of lending and not being profitable, right? And you have to, and technically, if you look at 95% of the revenue of any fintech platform will come from lending also. So in a way, lending is the most important component, but it's always the concept of the more beautiful girl looks like payments. But at the end of the day, when you want to be married, you need a rock-solid homemaker, and lending is that.
Okay, I'm not sure how gender activists will react to that. But Anurag, why is payment the beautiful girl?
Actually, they were the early movers, I would say. And if you look at any of the fintech ecosystems across the globe, I think payments is the gateway to fintech, right? That's how you are, and that's very easy to acquire as well, right? I mean, so today you don't mind your payments getting processed through one vendor or the second one or the third one, right? It technically doesn't matter to you at the end of the day. But when you talk about lending, right, and there are so many things that you look at when you talk about a lender, right, before you finalize a particular lender, right? So that's why payments is the gateway to fintech, and that is why you're seeing anybody and everybody entering through payments and then creating their space to venture into other products and cross-selling the other products, which is why this is the story for most of the ecosystems. To answer your previous question on what fintech is, and I think we have been deliberating on it for last couple of years, and even at DLAI, that was one of the things that always used to come up when we were talking about the eligibility, right? Why can't the biggies, the financial institutions, why can't we call them as fintech institutions, right?
Yes.
So I think one of the things that we sort of looked at when we were looking at the eligibility as far as fintech is concerned is any business that deals with money and primarily uses technology in one or many of their workflows that are required in their business. So that's how we can look at it. There can be a heavy bias towards technology, and there can be a heavy bias towards manual or physical interaction with the customers. And based on that, there are different shades that I would say, rather than actually giving a binary outcome as 0 or 1.
Okay. Riju, what do you think?
Yeah, so I think, I come from the payments industry, but I think for the Aam Janta, for the common man, I think it is probably the case that because they use UPI everywhere, right? But I think in the circles of fintech, I don't think payments is seen. I mean, if you ask a payments company like us, we'll say, it's all about lending, right? Because whatever you see RBI talking about, half of the time it is lending. So within the circles of fintech, maybe it is payments is not fintech, but for the common man, just because you use UPI every day, and the only way to change that is to find come up with a product which is used every day, so that a common man can recall, right? But do you even want to do that is probably a first question.
Okay, Anurag. Is it on? The mic is on, right?
Yeah. So, I mean, like the tricky part for me is that I come from PhonePe group, so we do everything. So, but yeah, I think on the digital payments, I mean, I run the wealth business and we do Share.Market, which is our broking platform. But one thing we realized that in India, especially as everybody said, see, digital payments actually is synonymous to fintech, because the macros of India to bring fintech as like the mainstream, like contributor to financial services led by payments. So that's why digital payments is so synonymous to fintech. But if you want to really look at what fintech means in terms of like traditionally how we look at financial services, I think I come from computer science background, and my entire life has been at the confluence of computer science and markets. And when we look at markets, we look markets very much from an engineering and computer science mindset. And I think if a company is trying to do or relook at how financial services is being looked at, and a core IP or the way they want to like create some meaningful product or distribute, if it's largely driven by very strong tech mode, I think that's where fintech or tech fin, I mean, you actually should put more weight on tech than fin. That's what fintech should be about. Like otherwise, I mean, there are banks for ages, they're brokers for ages, but why there's a the whole industry has been relooked in every segment. I think a lot of that comes from the DNA of how you build these businesses, which are very much tech first, engineering first, and culturally you look at building things at scale through technology.
Okay.
And that is where fintech is clubbed under.
Yes. Sorry, Ujjwal, I called you Anurag earlier, so apologies for that. Now, Srinath, these gentlemen have reason to be more cautious in what they are talking about. You can be more adventurous. Why does fintech suffer from an identity crisis?
So I think very clearly fintech is not a new phenomenon at all.
Yes.
First of all, we all think fintech is 10-year-old journey. It is not. According to me, the first
demonetization.
Which
people think it started with demonetization.
Correct, UPI.
UPI.
I think fintech journey in India started in 1992. I call National Stock Exchange as the first fintech company. We moved from paper stocks all the way to having terminals. So
right after the scam.
Right after the Ashwin scam. 91 was a scam, 92 NSE was formed.
Yes.
So I think if you look at that journey, BFSI as a sector has been the earliest adopter of technology, including AI decades ago. AI per se is 70 years old of research and investment. Suddenly we are all speaking about AI as if it is the best thing after sliced bread or chapati, whatever. So I think fintech has a identity crisis for the simple fact, I think it's also and here I'm being a little contrarian in my personal capacity, not as face. The challenge is even the policy makers look at fintech as payments because that's all they know. UPI, government of India brought this. So fintech means payments. How many of them know that stock markets, insurtech, wealth tech, everything is powered by fintech. Today, even if you're a bank and don't call yourself a digital bank, the reality is you cannot function without technology. And we're also, I think, confusing fintech. Are you consumer interfacing? Are you B2B, B2C? Or are you a technology vendor? You can be a plumbing pipe.
Yes.
Without that pipe, even that WC can't function, right?
Correct. Yes.
But we all look at, it's Jaguar, it's great fitting. But without that pipe, it can't move. I think so fintechs have multiple roles to play. And not every fintech needs to be consumer facing or glamorous. I think that's a disservice I would also kind of push back, even media has kind of done. Saying fintech, valuation, what's your valuation, all of those metrics.
Yes.
Fintechs can be profitable. They need not be large. They can be small team. They can solve deep tech troubles and challenges. And there are a lot of scientific theories that they use, principles they use in their entire engineering.
Okay.
So I think fintech, in short, the challenge for some of the lenders would have is, are you fin or are you tech? If you ask RBI, they don't care the amount of tech they do. You are fin, and you will be regulated as fin. And that's a big challenge of big tech regulations that globally regulators are struggling with. How do I regulate a Google or an Amazon? If somebody is here, that's a challenge that RBI would have. How do you regulate?
Yeah.
So technology is part of life, but that's not the core. Financial principles and the risk management principles would come first.
You know, you are tempting me to get into the RBI issue now, but I will resist that for a few minutes because I just want to go a little deeper into the fintech stuff. Why is it that fintech is seen to be synonymous with payments? Is that because the last big innovation in fintech was UPI? And after that, we don't really see that kind of disruption. I'm not saying it has not happened. I'm saying we don't get to see, get to talk about, get to hear those stories that, okay, something huge happened, which transformed lives, which changed the way people live and work and think. Is lack of innovation an issue with fintech, Srinath?
Personally, I think fintech, the last 3 years, there have not been any great disruption or innovation that has come to the market. The reality is that. I think all the gentlemen here would also agree that UPI jam trinity is kind of the fundamental backbone for Indian tech innovation, so to speak. So this is one of the few countries globally where the government and the regulator took the initiative to innovate and the private sector put wrappers around it, commercialized and figured out business models around it. But the challenge is probably it is time now regulator also to kind of handhold the sector and say how is it that we can take it to the market. End of the day, without consumer adoption, if COVID had not happened and Demon and COVID had not happened, would we be so familiar with payments? I kind of keep asking myself that question. Today, everybody, India is more keypad literate than actually formally literate. And thanks to COVID, everybody, we all learned, whether it is dealing with domestic help or buying on the road, everything, everybody jumped to the UPI bandwagon. So I think COVID was the best chief digital officer for India Inc., so to speak. So let's give that credit. But now coming back, I think you can't just innovate for the sake of innovation, right? I mean, innovation, you can't say, oh, I'm going to have 3 innovations next year, that is a KPI. I'm sure none of them are going to design their organization like that.
Yes.
It has to make commercial sense. Right. They're raising money with commercial acumen around it.
Anurag.
I think there's a fundamental difference between payments and lending that we have to also acknowledge.
Sorry, payments and?
Lending.
Lending, yeah.
The reason why maybe, there are more, I would say, advancements and, new concepts coming on the payment side is because that's fairly transactional, right? It's more about settlement, it's more about, it's more operational, right? But when you talk about lending, and that's why I keep talking about some of these problems in lending, I don't say they're insolvable, but I think there has to be a very, deep thought around it, in terms of, let's say, for example, MSME lending, right? We've been working on this, and banks have been working on this for decades now, right? And, there are 9,500 NBFCs today in India who have also attempted it. But frankly, none of them have been able to solve it because it's not an operational issue. It's not about moving funds from one place to the other, right? And maybe settling payments, settling bills, settling something else. It's about the credit risk, right? It's about the credit culture, right? And when you talk about that, the regulator is more sort of sensitive about all those things, right? Who are the stakeholders who are getting impacted? What is the modus operandi of the whole transactions or the entire lending process that is happening? Who is providing the funds? Who is taking the funds? So, it's a more involved, a more deep, I would say, subject as compared to payments. And, as far as MSME lending is concerned, and we have deliberated on this multiple times, what we believe is that there has to be a certain level of sovereign guarantee attached to it, right? Because none of the private players, and you've seen tons of examples in the market, where private entities have attempted solving the MSME lending issue. But unless there's a sovereign guarantee attached to it, right, somebody has to move forward and give the loan to these guys, right? Or these entities, and then check whether they are worthy of giving the, giving another tranche or not, right? So private entities cannot do that, right? They don't have the wherewithal to be able to bear that amount of, NPAs or defaults, to be able to find out whether the person who is new to credit, whether he is credit worthy or not. So, I mean, maybe we're not comparing apples to apples and oranges to oranges. Payments and lending are very different, right? So, the amount of free hand, I would not say that they totally have a free hand, but it's far more than what the lending ecosystem has as compared to payments.
Right.
Can I try to
Of course,
a
Akshay.
very different example?
Yes.
If I ask you name automobile brands, and you'll come up with 14 to 15 names in the audience, right?
Yes.
But there are hundreds of companies who help make a car or a bike or a vehicle, right? The same is what's happened in the, I would say, in the fintech era. Typically, a payment is done by everyone, from the mother to the father to the grandfather to the child, to everyone enables a payment to happen. You used to earlier get cash, the cash converted to digital way of transferring money. Eventually, a digital currency will come out where they transfer. When it comes to other elements of banking, it could be investments. Investments are looked after by one person maybe in a family. If it comes to insurance, maybe one more person in the family. If it comes to lending, maybe only the bread earner gets a loan for it. So number of people who it affects changes, but number of people who power the backend to enable that product is humongously large. If I ask how many of you know Hyundai also manufactures a GCB equivalent product, no hands will show up, right? But if I ask you how many of you know that there is Hero Honda also and there is Bajaj Motor also, all of your hands will go up. It comes from the same part. It goes a lot to do many parts of banking, and technology enablement across the board takes place. When something impacts all of us, we know the name, right? We definitely know what car is coming to pick us in Ola. right? So that's the difference which takes place in the market. When something, but at the back, the technology interface, the effort which happened to regulate banks globally has been phenomenally larger. And that's how each line function of financial services and banking gets impacted by fintech in a different manner.
Okay. Ujjwal, but before you start, I'll just provoke your thinking a little bit. Are you just putting wrappers around someone's innovation, or are you doing something really solid and meaningful?
No, we've been building something from scratch, like grounds up.
Let's talk about it.
Yeah, so actually, I just want to close on that loop, which is a precursor to what you asked. See, capital markets is actually one of those, access to investing in equities market is one of the other areas where India has actually seen a very good positive impact post payments, right? Because if you see the whole chain reaction that has happened in India between people who want to raise money to build things, build ambitious business from India and for the world, markets have actually facilitated that. So there's a lot of interest by people to put their savings money into markets, and that financialization of savings is actually the function of a lot of tech innovations supported by regulators and brokers, and the whole wealth tech industry has actually supported that. I think that's something which get lost in translation in the whole payments volumes, right? But if you look at the number of SIPs we do every month, 23,000 crores of domestic money, that's a huge impact, right? That creates a lot of positive chain reaction for people to raise money to build from India. And I think that it is not just about wealth creation, but also supporting the economy to build great businesses. I think markets have that positive impact, and I think their fintech has played a phenomenal role. Which comes to the next question, which you asked around what we are doing. So if you look at last 10 years of broking industry especially, 16 to, as you said about the Chief Digital Officer, COVID, from 16 to around COVID, I think if you look at the SIP growth in India, it was growing at 30% plus CAGR every month year on year. And we are right now at 23,000 crore monthly SIPs. Broking, in terms of people opening broking account, that was growing at around 10-15% till COVID. And then post-COVID, suddenly people realized that my human capital is not the only way to survive a life. I need to be very serious about my financial capital. And that actually brought a lot of habitual, fundamental change in how people wanted to grow their savings and started opening broking accounts. And part of that has been able to, people are able to open accounts digitally. Regulations actually caught up much before COVID happened. So complete online opening of broking account. So in last 10 years, the number of broking accounts are growing, in last 5 years, growing at 30% plus CAGR. But the biggest problem broking industry is facing, and this is still a problem, is that the number of people who have opened demat accounts is around 10 crores, unique PANs. Total demat accounts is 17 crore, but number of people who stays active during a year is only around 4 crore. So something is not right in terms of how you use your broking platform to trade and invest. So you make losses and you put your behavior into practice in a wrong way. So you really don't create wealth. But when it comes to mutual funds, for that matter, less than 5 crore PANs, total folios are 20 crore, which means people are realizing that there's some smart fund manager doing right, so they're putting more money and growing their money. Let's not go into the debate of active, passive, benchmark returns, all of that, but generally you are making better returns once you put with mutual funds. So on broking, how you can solve that problem where people actually can make contextually smart choices, intelligent choices. So we started in 2016 actually took a very bold statement that if India in India, people open broking accounts at population scale, how do we bring contextual intelligence at scale on broking platforms? Not driven by research reports, standard, which comes out, right? Through technology when people are using the product. So we constituted a new product segment called Wealth Basket, which is how do you bring portfolio style investing on broking platform? So that what it means is that we enable research arms of the broking platforms to actually constitute a set of securities into a portfolio and open that on broking platform. So once you come on a broking platform, while you can still do individual stocks, but if you want to invest in an intelligently constructed portfolio like a mutual fund, we actually ensured you can do that on a broking platform where you can replicate that portfolio. And when there is any change in the research of the underlying portfolio, you get update on that. So we brought that intelligence at scale through Wealth Basket on broking platform. And today when we have launched Share.Market on PhonePe last year, this is post the acquisition of the platforms that we were building since 2016. We are saying that discount broking model now moves beyond accessibility and pricing, and how do we bring also contextual intelligence on broking platforms at scale. And that is a very technologically advanced problem which we have been solving since 2016.
Okay. Riju, you have been largely silent. Is that because you are the payments guy? You don't need to talk.
No.
Your case is already well established.
No, I think my take would be that I think what tech scales, right? So the more tech you have in a business or a business model, it will scale. And you have to have more tech and you have to make it very, very, very simple. So whatever is tech heavy and simple will scale. So it's matter of scale actually that we're discussing tomorrow. If we can lend automatically without, like just someone enters a form and we just make it, and it will scale, right? Like just make capital available. So yeah, that's why UPI works. And then the question on innovation for us is, whatever we are doing, let's say KYC is a big problem, right? So are we applying those principles of, innovation or simplicity, there? Like I think it requires a lot of product thinking, design thinking to really make it simple and usable. So on the KYC point, let's say, why can't we use account aggregation, for KYC? So this is something the regulators can think about, and all of us can think about, right? So can we really make it simple, as account aggregator probably is? And then when we have something like digital identity like Aadhaar, right? Could we have, really made it very simple? Firstly, did we even need it? Like, could we have redone PAN, the PAN card, as a form of digital identity? Yeah, so I think the question is, how do you make it really simple and tech savvy? It will require a lot of product thinking, design innovation. I think it will start in the universities to really go back. And I think as Ujjwal was saying, right, like fintech is all about, engineering excellence, computer science background, right? So in today's world, that is about AI education, right? Like today, a lot of the problems when we are saying innovation, that comes from how good are we at, using AI, machine learning to solve problems in fintech. So that again, it starts with, having engineers who are trained in AI, who are trained in ML, right, who can solve these problems. And I think we're some way away from there, right? Like, I think once these people start coming into the workforce, and then they can, start, building these solutions maybe.
Okay. In a minute, I will check if there are questions from the audience. But before that, I want to ask Akshay, you were telling us earlier about these millions and millions of people who are actually using fintech apps, and for someone like me, those numbers were really striking. So there is a certain impact that you are creating, even though it's not payments, but then there are just so many people who are maybe benefiting from those services. How is that happening?
See, if I look at, there's a huge amount of demand coming in for consumers for lending solutions. If I look at a monthly level, last month 27 lakh people applied to us asking for money.
27 lakh.
That's not a small number. Right? If you look at the app, has 43 million, has received 43 million people who have come approaching asking for money. Right? That's a large number, and you wonder, where are these people? How are they coming in? Why are they looking for money? And if you see, we as a lender have the following rules. You need to be salaried, you need to have a savings account, you need to earn above, let's say, 18,000 rupees to apply to us. The app opens up and says, do you have these? Then proceed. And then you have 43 million people coming in. Right? So there is a huge demand there. There is lack of service. 100% of my customers have a savings account. 95% of them have a savings account with the top 12 banks in the country. But they've never used credit in their life. They've never been able to get a simple credit product. I think that's what's the game changer. When you are able to create such large impact, right? And behind the impact, you have to go behind and create use cases where you become, let's say, impacting economy. Today, 1/3 of the loans that we do, we don't charge interest because they're meant for healthcare or education purpose, right? Today, you walk into any large hospital or any university in the country, you'll find a zero-cost EMI powered by us, right? And that's a game changer. Imagine you're getting a cardiac surgery done. your health insurance maxes out for 5 lakh rupees, then you wonder what to do. At that point of time, an additional 5 lakh rupees that you pay over 24 months is a game changer.
No, but let me interrupt you. If you are not charging any interest, why are you doing it? What do you gain from it?
So we have built subvention. Just like you buy mobile phones on zero cost EMI powered by Bajaj, you can walk up to Leelavati Hospital and get zero cost EMI powered by 5.
Okay.
Right. So it's the same concept, but buying mobile phones is frivolous, right? But taking care of your health, of your own family member is of far more importance. And that's what differentiation takes place. It wasn't possible in the physical world because you can't invest in physicality to do that business. But when you're integrated into the hospital management server and the surgeon pings you, I'm about to do a surgery, I have 5 minutes to start, I need 5 more lakhs, that's the type of treatment to be done, we're able to facilitate that treatment. That is game changer because you're building technology to interface to find out what's the surgery, why do we need more amount, why the insurance can't pay. And that happens in runtime. That is technology backed by fintech. And this is where the type of people who work for you, type of technology interface that you work is very different from traditional banking, and you build in use cases to build out a business model better.
Some people will argue that phone is more important than health, but that is besides the point. But Anurag, is that your experience too? Are you doing something where traditional banking cannot go? And
So we are into the B2B side of it,
Yes.
and we are helping businesses with their invoice discounting requirements. So I think, and when we started, this model didn't exist, right? So what we did was, so I'll tell you the concept behind it. So when we started, we saw a country which is growing at 6+% GDP growth rate for like years now. So obviously there's a lot of demand for credit, and there's a lot of people who would back that. On the other side, what we also saw was that there was a lot of money lying idle in savings deposit, fixed deposit, liquid funds, and so on and so forth, which is obviously, if people had better options to invest that, they would obviously do that. So what we thought was, if you're able to create a bridge between these two sides, right? On one side, you have businesses who are looking for credit, they're not getting it, they're not able to grow. I mean, in a country where we're growing at 6% plus growth rate, there is a lot of need for credit, which the banks are not able to, fulfill. If you are able to connect this, the surplus funds that are lying on this side to the other side, I think we are solving the problems on both the sides. The businesses are getting credit, and the investors are able to get additional surplus, additional interest on the funds that they're lying with them. Those are surplus funds. So we connected them through a technology platform, which is a pan-India platform, and it currently operates in more than 500 cities. It's a 24/7 platform where you can, anybody who's an investor can get in, including private investors, HNIs, family offices, funds, and anybody and everybody, and they can look at the deals that are listed over there. They can actually go ahead, buy those deals, do those transactions, and eventually in the process what they're doing is they're essentially funding the working capital of the businesses. So it's not a B2C platform. So no individual can get that money. Only a business will be able to get that money, and it's a curated platform. So not all businesses can get listed over there. So they go through a due diligence process. There's a credit underwriting that goes behind it, and only then they get listed over there. But anybody can buy. So that was a model that we were the pioneers in this space, and we got this to the country. And today we are proud to say that we have disbursed more than $6 billion in the last couple of years.
Oh,
and
there are
so indirectly we have sort of impacted more than 25,000 businesses who are sort of responsible for more than almost close to 1 lakh in terms of the jobs that are getting created and sustained on a regular basis.
Okay. I'll invite questions from the audience. When we come back, we'll talk about some restricted subjects. Anyone from the audience? Can someone get a mic to this gentleman here in the middle? Thank you very much, Akshay.
Thank you. Thanks. My name is Kishore Tiwari. I work for Caliber Business Support Services, and we primarily provide HR services to BFSI and fintech organizations. Since we are talking about regulations, my question is, I hope all of us will agree that the biggest setback which happened in the fintech industry was when Paytm was stopped from using its wallet business. My question number one is, I don't understand why only Paytm wallet was stopped, because if Paytm had a wallet, Uber also has a money, Uber called Uber Money. Similarly, Flipkart has a wallet, if I'm not wrong. And my second question is, which are the other fintech businesses which are at risk currently, which might be stopped by the regulators in the future? These are my two questions. Thank you.
Mr. Tiwari, you are causing a small disruption here.
Yeah.
It's a subject that's a bit sensitive.
Okay.
But we'll see. We'll come back to you, sir, in just a minute. Let me see if anyone on the panel will take the question.
I expect the panel to be more political and answer it the way they like.
They will decide. If nobody answers, I will. But
Let me take that.
Shanath is ready. Yeah.
So I think the way your first question about a particular entity, I think there is enough available in the public domain why they got into regulatory trouble. It is nothing new, and I think it has been happening for a couple of years. It's also unfair without the company being here for us to pass judgment on it. One, there was a regulatory breach that happened, and regulator took action against it. It's as simple as that. Two, to ask I will answer it very broadly here as a quasi-member of the SRO. Very simple. Which are the businesses at risk? If you are non-compliant, whether willfully or by design, you will be shut down someday soon. That's all. So there is nothing, the regulator does not pass judgment on a business model or the commercial model of any regulated entity. I'm not speaking only about RBI, whether it's SEBI or IRDA. There are regulations for a reason, because anything in financial services accesses public monies. If you're an NBFC or a fintech lender, you're anyway borrowing money from the public deposits. And if you look at it, I mean, very interestingly, Suvin, banking as a sector has not changed for the last 600 years.
Yes.
A lot of my banker friends won't agree.
Yes.
Since Medici dynasty, nothing has changed. You borrow money from the public, you do onward lending, and the spread is what you live on. It's as simple as that. Some of the gentlemen power each of these distribution pipes and data pipes. But what has changed in the last 10 years for sure, all of them and more fintech companies, is they are able to use the power of surrogate and parallel and new data sets, which the traditional regulated entities, banks, insurance companies, never even looked at it. They said, how can I look at it? I want you to come to my branch and give me a printed payslip, sealed and stamped by your HR. These guys said, damn you, I don't care, you upload it on a PDF, I will source it from somebody, I will look at algorithms of your social media. I think that is what has changed. I call it spare the rod, spoil the child, but rod, I always say, it's written on data. These guys are far creative in imagining how can I leverage and use data. The traditional entities, including most of our Indian banks, and I'm saying it as a customer, not as an SRO, just lack plain imagination. They can't say it, I'm saying it as a customer. They power them. You have to use data. Simple example. The entire financial services is all about pricing the risk. Whether you lend, whether you take deposits, whether you give insurance, you're pricing the risk. If you are a customer going on social media and saying, hippie, Thailand, here I come for 10 days. If I were your house insurer, I should charge you additional risk premium for it. By the way, these are commercial models already available in US and UK. They can track your social media, you're giving them authority or right to track your social media, and the risk premium changes. If I were a health insurance company in India, I would say, I want to give you a free Fitbit or an Apple Watch with access to data, so that your health premium will increase if you don't finish 10,000 steps every day. During festive season, it should go up.
Yes.
And I think we are also seeing some of these models are already present in Indian fintech. So it's not as if it's something new we are borrowing from Western world. It is all about data and how do we use data. Some of which our regulators may not be very comfortable so far.
Yes.
My belief is in the next 4 to 5 years, they will also come around it. As long as these gentlemen can show stress testing of how will they protect that data and how will it not be misused, I think regulators are also okay using that.
Yes.
I think I would like to add,
Sure, Anurag.
what Srinath just mentioned. Let's not blame the regulator. And we worked very closely with, some of the regulators in India. So while they are conservative about, a lot of things, they are by far very, very calculative, very, very sort of, deep in what they are doing. Right? Every decision that is being taken by the regulator goes through, a lot of evaluation, lot of scrutiny, lot of eyeballs before we see it in the public, right? So any decision that comes out goes through multiple channels, multiple levels before it comes out in the market, and there are genuine reasons why these decisions or orders or notices that come out in the market, are there. So they're there for a reason. So, it's not about that there's a problem with the regulator. What I would say is that the industry is going through an evolution, right?
Yes.
And I would say that, regulators have given ample amount of time to the fintechs or the financial services industry in general over the last couple of years. Now is the time, when you're seeing, an exponential rise in not just in terms of the digital transactions, but also in the usage of all these apps and tools that the consumers are using. So there is a need to set some guardrails in place, right? So you need to know the highway where you have to run. You can't just be running on any field and every field that comes, in your way. So the guardrails are being set, and I think we should honor that. We should, abide by that, and it's being done for the benefit of the country. So, there's no point in blaming the regulator, because all these decisions are being taken with, a lot of detail.
Yeah, Akshay, want to add?
I want to simplify your question and answer actually. See, when you are young, you want to do a few mistakes, right? अगर बच्चा गिरेगा नहीं तो साइकिल सीखेगा नहीं, right? हम छोटे थे, हम गलती कर रहे थे, अब तो बड़े हो गए, right? We are running this company for 8-9 years, all of us. So it's time that whatever you are doing wrong should get corrected once for all, right? So he's taking that corrective action. If he did it too early, we wouldn't have innovated, right? Some of the work that he's asking us to do today needs a lot of effort and intelligence and processes and people. At an early stage, we couldn't afford those processes and people. As you build businesses, it's a great time to go and do it now. Right? Paytm was a large company, right? He was asked to correct. He did not correct. He faced the penalty, right? As long as the regulator puts the guardrails of how to do it the right manner and we comply, there's nothing wrong, right? Banks are banks and they're large institutions, right? You park your savings there, right? That's a large amount. When a public puts in money, that's the biggest amount of element, right? As we grow, as we become large FS businesses, we need to be better governed. It's the maturity going from adolescence to actual adulthood, and we're entering into that phase. It's the time to regulate. It's the right timing.
Yes, yes. Riju and Ujjwal, would you like to pitch in?
See, I can give a very independent perspective as a builder innovator who worked in, let's say, capital market side. One thing when we started also, we were very clear because we were trying to solve a very long-term problem to bring research at scale. One thing we always, when we looked at the Securities Contract Regulation Act, SCRA Act, like if you know in India, when most of the stock research for the longest time in history of broking industry is individual stock level research. So when we wanted to bring portfolio level research, we looked at the current, the regulations which came out from SEBI in 2013, investment advisory regulations, and the research analyst regulations which was there. We could not find on first principles that what is the way to provide portfolio level research. We went deeper into SCRA Act and saw that group of securities is defined in the definition of securities, but nobody ever used it. So generally, regulators, what they do is that the areas where the spirit is always known, there's no knee-jerk to the outcome of a regulation. It is built with a very long-term view. But for innovators, if they find some advantage or some opportunity within that regulation, generally regulators work with you because if your spirit or the intent is in that long-term intent of the long-term spirit for which the regulations have come. So therefore, innovators and builders, regulators work with you, evolve the regulation, because it's like glass is half full or half empty. You can look at half full is what regulators have provided, the half empty is the opportunity for you to fill. And regulators work with you. So I think their regulators have done a great job, especially I'm talking from a SEBI context, where they have evolved the regulations. For example, right now, portfolio level research is being added as part of the consultation paper. It took 7-8 years for them to understand the evolution, because from a customer point of view, it's the best thing to provide a group of securities as a research on a broking platform, and they are changing the regulations. And the spirit was also there to do this. The innovators need to catch up, find that opportunity, build it. I think, so we need to look at this longer term spirit is always there. We need to go at the edge of regulations in that spirit and work with the regulator, and they evolve.
Yeah, I think I would just say that the RBI, I think, cares about protecting the interest of the customer and systemic risk. So, I mean, if you're an adult fintech, as Akshay said, right, you have to really be, within the guardrails. But if you're a child fintech, I mean, and if you're trying to take liberties, like just ensure, you don't kind of upset the systemic risk, or, keep the customer interests in mind, like don't burn down the house, right? And as long as you do that, it's okay to, kind of, as you're innovating, and you're kind of trying to break some corners, just keep those two things maybe in mind.
Okay. We'll take one last question from the audience. Gentleman here in the middle wanted to ask.
I just wanted to know your views on decentralized finance, which is both finance and tech, but without intermediaries. So my question is, are the current regulations closing the path from traditional view of fintech to, innovation in peer-to-peer finance using DeFi?
Decentralized finance using technology.
So let me give a principle-based reply of what all the regulators in India are saying. And this is India's position at G20 and IMF as well. Anything that does not have audit trail, traceability, trackability, and data governance, the Indian financial regulators are not comfortable with it. And the moment anything that touches around the sovereign authority, no way that any of our regulators are going to give in. I mean, which is why we saw the pushback from RBI on cryptocurrency.
Yes.
You go and tell them about virtual digital assets, and you probably regulate it under SEBI as a MII, I think it will fly. But you kept on saying currency, which is actually intruding into the sovereign right that I publish the currency. There was a pushback. So anything where there is no audit trail or data governance, I think there will be a challenge. Just as an analogy, there are parts of DeFi, and let's say on the same crypto, if you talk about blockchain, it is already being used in the industry, and regulators are fairly comfortable around with it, and they're also aware of it. It's not as if, let's not take away that credit from them. It is not just finance that they understand. They do understand the operational aspects of how to operate that and the technology aspects of it. So I think DeFi, without governance around it, they're not going to fly at all.
Anyone else? Decentralized finance?
Yeah, I think I just add that the decentralized finance, like the core basically, let's say, where you are assuming that the system provides the trust of the intermediary for, let's say, a transaction between two parties. I think the technology, which is the blockchain, I think it is being deployed and being piloted in various forms in under the hood in many ways. I think from a government and central, like the banks and all, like the regulatory part, they just don't want to actually, that's a world order for ages. I mean, it is an evolutionary phase for decentralized finance. At least the technology is being adopted in many ways.
I don't see it happening in payments anytime soon. I think there would be other use cases, but I think payments practical and regulatory wise, I don't think there is any path for it to happen. Like, I mean, we have seen e-rupee, but I don't think it will be a reality very soon.
I think sovereign authority is the biggest, I would say, roadblocker for any of the decentralized, concepts to become mainstream. Because, so far as you don't have any traceability, so for example, why was there a ban on old currency notes, right, once the new came in? right? Because you can build an economy around it, right? People using the old currency notes, dealing in it, they can have their own ecosystem. There's no control from the government, as far as that, instrument is concerned. So I think, India is far away from it, is what I feel, as far as the regulators are concerned. Even in more developed economies like US, right? So while we've seen some sort of an acceptance coming in, but they're far away from becoming mainstream, is what I would say. I mean, they're nowhere near replacing dollar by any chance.
Okay, we have come to the end of our time on the stage. But first, I'll thank the audience for raising the one question I was hesitating to raise. And I thank the panelists for not shying away from it. If I can add one thing, I think whatever the chatter about the regulator, the sense I get is that their action is not ad hoc or arbitrary. There is a process which can sometimes go on for a year, 2 years, maybe more. People are given enough chance to respond. There is to and fro. So I think, and like you gave the cycle example, right? You also. Someone elderly holds the cycle from behind in the beginning until you learn to do it on your own with safety for everyone, right? Thank you very much. It was a pleasure.
Thank you very much. May I please request you, Suveen, to present the mementos to our panelists. Very interesting discussion, and it was also interesting to know how our data that's floating around makes our lives convenient, but also kind of poses the kind of risks. I'm glad I'm not wearing a Fitbit. Our next panel discussion will be at 5:45 p.m., where we'll be looking at technology in banking. So see you then. Thank you very much. for your patience. We are just going to begin. Our panelists are here. So this is the last session of the day in this hall, and it is going to be on banking on technology. And I would really request everybody to please settle down. We are going to be starting the session. Also, please kindly put your phones on mute. May I please request everybody to settle down? We are just beginning the session. So the discussion is on technology in banking. So banking on technology, and where does one even begin to start this discussion? Technology is today, of course, the backbone of the banking industry, and the confidence that it needs to inspire cannot be overemphasized, particularly given all the kind of frauds and scams and all the jamtaras that we come across these days. Besides the safeguards in place, what can one look at in the realm of technology in the banking sector that makes it faster, sharper, more convenient for people? How can, of course, artificial intelligence and machine learning be leveraged? All that and more we will be listening to in this panel discussion. May I please request our panelists to come on stage? We have Mr. Baldev Prakash, MD and CEO, J&K Bank. Welcome. Mr. N. Kamakodi, MD and CEO, City Union Bank. Mr. Praloy Mondal, MD and CEO, CSB Bank. Mr. Tushar Vikram, CEO and Country Head, Mashreq Bank, India. And moderating the discussion is Business Standard Banking Editor, Mr. Manojit Shah.
Very good evening once again. We have an extremely diverse panel today. From Srinagar to Kumbhakaran, and from Dubai, and of course from Kerala. So extremely diverse. So Mr. Mondal, Mr. Prakash, Mr. Vikram, and Mr. Kamakodi, all of them are here. And we will be discussing banking on technology. Now, as we know, in the last decade or so, technology has progressed immensely, and banks have harnessed the technology to advance their growth. India is actually at the forefront of a digital revolution, leveraging on digital public infrastructure, a vibrant financial technology or fintech ecosystem, and a very conducive policy environment which is emerging as the fastest growing digital economy in India. We all know how UPI has progressed over the years. Just to give an example, digital payments have recorded a compound annual growth rate of 50% in volume and 10% in value terms between the 7 years period, 2017-18 and 23-24, involving 164 million transactions and almost 2,500 lakh crore in FY24 itself. Of course, as we know, digitization presents unparalleled opportunities. At the same time, there are significant risks. So in the next 40 minutes or so, we will dwell on some of the areas which are focus area for banks. For example, the first thing we would like to know is that I would seek opening remarks from all the panelists here on an issue which is dominating the banking space. It's cybersecurity. In India, security incidents handled by the CERT-in has increased from 53,000 in 2017 to more than 13 lakh during the first 8 months of the last year. The first question we would like to ask is how they are dealing with these cybersecurity challenges and how they are investing in these cybersecurity issues. We would like to request Mr. Prakash for his opening comments.
Thank you, Manojit. So, cybersecurity, we used to have a tick checkbox as far as compliance is concerned in the initial days, say late 90s or early 2000. But after the landscape of digitization, the digital service has increased. Cybersecurity every day is becoming extremely important. Of course, the banks have learned lessons hard way. Lot of incidents about the cybersecurity attacks on the banks have come to light, which has resulted not only with the financial loss, but the reputational damage also to the banks. So, cybersecurity is no more a compliance-only issue. It is the existential challenge for the banks, and that's why the investments towards cybersecurity has been separated from the overall investment for IT. The IT is separate expenditure and cybersecurity is separate. This is as per regulatory guidelines. So a lot of investment banks are doing. I'm not sure whether we can say it adequate, but I believe it is improving every day and every month. But it looks like that we are prepared for improving the cybersecurity framework of the banks, and we have to continue doing it going forward also. There is no other option. We have to continue sustaining our business, sustaining our customer, the interest of our customers by working on the cybersecurity every month or every year.
Thank you. Thank you for your opening remarks. Mr. Vikram, you are a foreign banks and technology-driven banks. How do you see the cybersecurity threats and what kind of steps you are initiating?
Well, I would say, we at Mashrak are very technologically driven bank. Probably we've got the maximum number of awards as being the most advanced bank from a technology perspective in the Middle East. So that brings a lot of challenges also, because as a result, with that advancement of technology, we have a lot of cyber attacks and people doing it. I mean, this figure is not known publicly, but generally, what we've seen is that banks in India, they have over 1.2 million cyber attacks a week. That is the figure which people are dealing with, and that is the propensity of those. So we, as a foreign bank or Mashroq, which operate in 20 countries, have to ensure our firewalls and security packages are equal to, across those countries. And we have also do a lot of ethical hacking. That is, we do it ourselves to check how robust our systems are, and we have a process of what is called L1, L2, and L3. L1 is done by us, where we try and break into our own systems. L2 is where we get one of the consultants, which is like a Deloitte or a EY and others. And L3 is really the most advanced, where we get one of the security firms to sort of do that, and they really test our systems. So we spend a lot of time to ensure, not only design our systems in such a way it is not, but constantly check them that they're not hacked from that perspective. Because this field is so evolving, and the customer confidence is very key to prevent any kind of cyber hacking and frauds from that perspective.
Mr. Kamakodi took charge about 13 and a half years back. He has seen the entire specter of the digital transformation as a CEO of a bank. What is your take on this, sir?
Yes, as you rightly said, so when I started, perhaps we had branches which were working on manual ledgers. So we have seen ALPMs, then migration to core banking, then getting into your internet banking and mobile banking, the digital era. How much, whatever you say about, you estimate about the cyber risk, you will not be able to get to the, like say, you can't with 100% certainty say, like say, we have crossed everything and all. Because always like in the fight between thief and the police, thief will always be ahead of the police. Like that, the spirit which is needed for particularly users of how you need to protect from the cyber security is something which any statement will be an understatement, which we have to keep in our mind. Basically, if you look into like as you rightly know, I mean, you may like say the largest two users of technology, one is your airline industry. It is closely followed by the financial services, particularly banks. You are seeing now the cyber attackers or attacks are happening in perhaps in the supposed to be the top technology companies which got attacked because of their cloud were attacked, and you had the airline industries, like say a couple of days the booking and all were not available. Even in the couple of months back, the entire world saw the damage of that. So in that way, always we have to be resilient, but the response by, as you said, by be it certain or by the regulators or by the industry body, everybody is trying to have the maximum, like say, investment. It is more than, like say, just investment, like it's the, what do you call, the rigor with which the organizations are gearing themselves to evaluate the type of attack, how to look into and all such things. Like if you broadly classify, you have man-in-the-middle attack. To greater extent, you can do it by the, like say, by having a proper, like say, the firewalls and other cyber security measures you can have. More, I mean, you had many banks which had impacted because of that. After that, you had cases where the attackers, they seized your database and asked for the money and things like that. And you have cases, these things are like say on a level. But at a minor level where even the customers and common man were fooled and they were made to give their credentials and whatever frauds which are happening, for which unless and otherwise 100% people become like say absolutely aware of the risk and restrain from giving the credentials, you don't have like say, you can't stop that. So at multiple levels, everybody day in and day out, like say the protocols are given, you have CISOs, these sort of designations were not there 10 years back. So much evolution has happened. So everybody is trying to, like say, stay always one step ahead of the attackers, and apart from, like say, you have to do everything, and also you have to add this in your morning prayers that nothing should happen to us. So combined with all these things, ultimately you need the divine intervention to take care of that, and we see that's the thing. It's not just the investment alone. More than investment, like the rigor with which you follow, what is the weakest link in your system on a continuous basis, and what are all the technologies which are used by the, I mean, you have to think like a cyber fraudster or attacker, and tune yourself to be ahead of that. That's become a very important point at this point of time.
Thank you, thank you. CSB Bank, which was earlier known as Catholic Syrian Bank, is now changing its game to become a new generation technology-driven bank. So, Mr. Mondal, what are your initial thoughts on this issue of cyber security?
Hello. Yeah, thanks. No, I think it's a very relevant topic of discussion today, and I just walked across from the other panel discussion which is happening, and there Tamal Bandabada and Nitin Chugh, who's my ex-colleague, are discussing the same thing, frauds. And unfortunately, of course, frauds have many aspects to it, identity theft, which leads to much larger repercussions, but broadly, people gets impacted on the financial side, and hence, from a fraud, cybersecurity attack, those kind of things eventually impacts banks, financial institutions, and hence customers. But what's happening globally as well as in India is, and today India is pretty much connected with global. I mean, Manoj, you just asked what used to happen 10 years, 20 years back. I can tell you that I was in a visa conference somewhere in Australia 15 years back. And it was not a very motivating comment to hear that the reason India has low fraud ratio is because investors don't even, because fraud is an investment. They don't even find India as a fertile land for investment. That's why fraud ratios are low, which was correct at that point of time. But in the last 15 years, from where we were as a country to today, the whole world is looking at, from a digitization, the kind of numbers which we are seeing on the UPI transactions and various digital connectivities, etc. The whole world is also looking at India, and we are pretty much well connected. And hence, this has and will continue to become a major hub of cyber attacks. And we all know that last 1 year what has happened, and how many attacks are happening on the banking ecosystem and things like that, and what all protection we have to take, and we are taking constantly. And the good news is that so far, it's a cat and mouse game, as Mr. Kamakudi said, rightly so. But hopefully, we are ahead of the curve at this point of time, because we have not really heard too many instances where a major cyber attack would have created a major issue. But the work that goes behind, as we say, I used to do dramatics in my college days, I can say that people who stand in front of the stage are facing the audience, but the real work is happening behind the scene. And 80% of the work that happens in dramatics is behind the scene, right? So that is what is happening. The amount of investments, the amount of collaboration that's happening across banks, on various parameters, there is no competition. There is only collaboration that works. The amount of technology which is coming in, and while technology is good in one way, but technology also brings in various kind of cyber frauds and things like that. This entire AI ML, which is just starting actually, if you ask me, and the way this thing will evolve over a period of time will make it 10x more complicated, and hence banks have to be ahead of the curve, because the fraudster has to make, or these attacks has to make one success, but we have to protect hundreds of such attacks every day. And hence the amount of investments and amount of time, if you ask me, that today the CEOs of banks are spending at least 40% of the time on, not on business, but on two things, compliance and security. Okay. And this is nothing but security, because for banks it's security, especially with a kind of cyber challenges which are happening right now. And those guys also have enough intelligence and enough investments, because there's a business for them. And the kind of, and there is a responsibility, I'm sure you will cover that some stage in this conversation. There has to be responsibility at the bank end, there has to be responsibility at the customer end.
I'm coming to customers.
Yeah. Yes. And more importantly, because the whole ecosystem is connected, It's banks with banks, what do? People do transactions. Transactions for what? And those systems also has to be connected and evolve over a period of time so that there are no risks evolving through those firewalls and things like that that's happening in the bank. So I think it's a very, very important topic you have chosen.
No, I mean, as Mr. Kamakodi said, investment and banks' preparedness is not enough. There's a divine intervention also. In that context, the customer awareness and customer education, how our banks realize that that is also an important part?
Is it for me?
Yeah.
Yeah, no, absolutely. I think at the end of the day, it's no longer a situation where customers who's not educated enough on banking or frauds who are getting today compromised. The highest level of customers, bankers, people who are regulators, we see as individuals, they also at times get compromised. And the reason for that is that previously, as somebody said, that it used to be greed, but now it is fear. There are a lot of messages we get. Today only my daughter sent me a message saying that I got an India Post message and all that. The first thing I said that you must not open it first of all. And while I did that, I got a call from Indonesia. Okay, so this keeps happening, and basic education which we have to do, it's not a any more good thing to do. It is a must. Is what are the constant evolution of frauds which are coming up, and how we need to continue to message our customers, communicate to our customers, train our customers where they can go wrong. Customers and our employees as well. We do a cybersecurity compliance kind of a training almost every week, online as well as in person. And training and communicating what's happening, because this is an evolving space and constantly something or the other is evolving constantly. It's extremely important. So customer education, customer communication constantly. Also what we do is internally, we, as someone said, ethical hacking, we also try and see how internally our people can get compromised, and hence then we send those phishing mails which internally to ensure customers as well as our own people get educated on those kind of things so that they don't fall prey to the real fraudsters at the end of the day. So there's a lot happening on that front. I think government is doing a lot of things, the regulators are doing constantly a lot of things, but this is, as Mr. Kamakodi says, it's a cat and mouse game at the end of the day.
Right, right. Mr. Prakash, you come from a geography which has security implications, security challenges. So how do you see customer protection, customer education, customer awareness? What kind of challenges you face there?
So, as Mr. Mandal has said, a lot of awareness, customer education and awareness efforts has to be continued on an ongoing basis. We, from our side, we are doing it. We are actually having every Sunday morning a customer awareness program, particularly focused on the cyber security on the radios. So, and that is becoming very popular. So, that is one step, and I think the RBI Kehta Hai campaign, which is getting a lot of impact actually on the customer awareness. So, regulator, government, and the banks together, I think we should continue doing it in a large-scale manner. But one thing I think I would just supplement Mr. Mandal, what he has articulated, that if certain at any point of time customer has caught with some attack, he has lost money. So instead, sometime our branches or our people finding faults, sir, aapne ye nahi kiya, aapne wo nahi kiya. Instead of that, first let us try and handhold and take care that customer is not, is not too much worried, and then we should settle the claims, if it is genuine claim, as soon as possible, so that the overall confidence of the customer is lost in the system. So, and of course, the investment on staff, it is again a continuous process which we need to doing it. And I think this is the way forward. This is the way forward. It's a continuous process, and I'm sure that we are on the right track.
Before coming to Mr. Vikram, I just want to know from Mr. Kamakodi very quickly, what has your experience on both staff and customers front, so far as awareness is concerned?
See, by and large, if you look into the number of cyber frauds and like say complaints what you give, 99.999% or even more, the actual money loss has happened where the customer has given out his credentials, whether it's OTP or whether it's password or whatever. And the instances when the cyber attackers have actually got into our server and done some mischief or man in the middle attack, those are all the problems of the bank where we were also victim of one such attack. So in terms of volume, it was there, but in terms of the numbers, there are only handfuls where the customer had got into your server and done something. So remaining cases, all it is purely based where the customer has given out his credential. There is always a balance between the ease of operation and the security features. So all the features are now available in the mobile banking app of all banks. They can log their transaction, they can limit their quantum of transaction per day, they can limit the number of transactions. You have now protection in almost all, mobile banking apps. But these sort of things happen only when the individual customers, they try to, they feel that I have to do this for every transaction. It is inconvenient to do. There is always a trade-off between the security and the safety. So what is to be done is that we have to repeatedly, we are also keeping on, and the role of magazines like Business Standard and all are also important to tell the customers on a continuous basis that don't give the, password or credential at any come what may. That should be the, they have to be very careful unless and otherwise it is originated by them. For all other transactions, they should not give their credential and no bank asks for that. If that particular point is protected, 99.9999% of the issues can be addressed.
Correct. Thank you. Thank you. Now, Mr. Vikram, coming to you, so far as banking and technology are concerned, and how do you see the India opportunity in front of Mashreq Bank? I know that 5 years back, Mashreq Bank changed its gears to focus on India. So what is your formula to become a successful bank in the Indian turf?
So, we are the largest private sector bank in Dubai, and as a bank, we decided to grow overseas and are present in 20 countries. And for Mashreq Bank, India is the largest overseas country from that perspective. And what we are doing is that in terms of our products and solutions which are there, are more catered to the corporate requirement. And as we see Indian companies more globalizing, from that perspective, a bank like us plays a very important role in terms of providing them, facilitating their international trade. A lot of Indian companies are going overseas, acquiring new companies. We play again a very important role. And what has also happened is that India, Middle East, right now the partnership is at the best. The Comprehensive Economic Partnership Treaty, the CEPA treaty between India and UAE was signed in 2022, where it was that the non-oil trade between India and UAE should touch $100 billion. So a lot of the Middle East companies are investing in India. They're investing in healthcare, food parks, and a lot of other endeavors. So a bank like us brings those Middle East companies also in India. And we also have a very robust financial institutions business where we provide dollar liquidity to various banks in the country from that perspective. So it's like providing a complete solution to both our corporates and FIs for meeting their both domestic as well as international requirement.
Right. I will come back to Mashreq in a minute. But before that, I would like to know from the banks, Indian banks, that RBI has raised this issue on the IT budgets of Indian banks. I would like to know from Mr. Mandal to start with, what is your, do you think your IT budget is adequate? And what is the proportion of your IT budget, IT expenses as a part of total expenses, and where do you see it going 5 years down the line?
No, it's a very interesting question because many years back we used to think that if you invest more into IT, eventually productivity will go up and your overall cost to income will come down. but that has actually not happened to any bank.
Right.
And the reason for that is that this is something which, yes, increases productivity, but this itself creates a huge opportunity to do investing into the future, and constantly you have to keep investing. Because if I have to say that if you're in the business of banking, you're almost in the business of technology today, in today's world. Especially if you're in the retail banking part, transaction banking part, you cannot be not without technology. So to that extent, I think it's a continuous process. Investments, and typically the bank's investments from an OpEx perspective, technology cost varies anywhere between 7 to 10%, most of the banks. From
expenses.
Overall operational expenses, if you take, I mean, simple P&L like NII, cost within that OpEx, then NPA, and then what is your PBT, that's the way we look at it. So within cost, there's an OpEx cost and operational cost. And the cost typically is anywhere between 7 to 10, 11% is, depending on the banks, is in that range. People are today bound to invest because without that investment, you cannot really run a progressive forward-looking bank going ahead, okay? For us, of course, the story is a little different because we are transforming the bank in a very different way. We are a 103-year-old bank, but we say that we are a 100-year and 103-year-old startup at this point of time. So we are majorly investing. And good part about investing into technology is a lot of these things happens into CapEx, and hence by the time it moves into OpEx, the revenue starts kicking in. And to that extent, it doesn't impact the cost to income the way operating cost, which is non-CapEx operating cost, hits you right away. And eventually by that time, the operating leverage starts kicking in, and then we start picking up. That's why technology investments are happening. But if you broadly divide the technology investment specifically into 2-3 parts, one is, because within RBI also there is CSI, there is various divisions within that who are looking at how you are investing in technology, what kind of things, how you are protecting the bank, what are the advanced investments which are making products, processes, and so on and so forth, and how do we protect the customers. So from that perspective, you have to see what we discussed in the beginning, the cybersecurity part. The second one is the basic core and the surround system and the digital infrastructure. And third one is, of course, how do you create connectivity and the other things which are customer convenience and those kind of stuff. If you broadly divide into 3-4 parts, I think the investments will continue to be in the 8 to 10% kind of a category of the OpEx of the banks. And for a bank like us, it is a little high at this point of time, primarily because we are revamping. Almost every technology which will be the bank 2 years from now was never in the bank before, and almost everything which was there in the bank 3 years back, almost 90% of that will not be in the bank. That's the way we are developing the bank. So for us, it's a little different as a story at this point of time. But broadly, I think investment of around 7% of OpEx will be required in any bank to run it progressively for the future, because we have to protect the bank and run the bank and grow the bank.
Right. Mr. Prakash, as the volumes grows, we see the exponential growth of UPI and other digital. So it is the capability of handling those volumes must increase. In that context, do you see a significant increase in your IT expenses going ahead?
Yeah. So if you see what type of volume the transactions are going up, the major transactions are going up mainly because of e-commerce, UPI, and mobile banking, or payments transactions basically. If these type of transactions can be shifted from your core to the cloud adoption, and then I think your core can be freed from the routine transactions. So in our bank specifically, I think this has been a success story for us because we are following cloud-first strategy. So if the transactions or any business can be shifted to cloud, we are trying to do that, and a lot of investment has been made on that. So because of that, you see in many banks, in almost all banks, you don't find much of the outages because of the increased number of transactions. I think we are strategically doing it. We have to continue doing it, and then now the APIs, the open banking platform is also coming handy as far as the handling of volume is concerned. So I believe that we are working on the right track. We have to continue exploring these possibilities so that the increased volume can be handled in a more effective and efficient manner.
Mr. Vikram, you plan to grow in India in various fields. So your volumes will also grow. In that context, what is your perspective on IT-related expenses, if you can throw some light?
Yeah, so I mean, we are building up for scale. So our systems are global systems which can handle the volumes which are there. So we don't, and what we are trying to do is not only invest in for scale, but also customer experience. So we are working both on improving the customer experience as well as resilience of the operating system. Another very important aspect, these are operational part, but another part where we are spending a lot of money is regulatory reporting. We are trying to, because these days RBI or any other regulator wants accurate reporting to be done.
Accurate.
That is very important, and technology can play a very important role there. So we are trying to automate as much as possible the RBI reporting reports and other reports which we have to do to ensure they're accurate, timely, and data-free. So apart from operations, the compliance aspect is also something which we are spending a lot of money and time and effort to streamline.
Right. Mr. Kamakodi, along with technological upgradation, there is also issue of skilling, reskilling and upskilling. How do you address that?
See, just to add to my previous speaker's view, on one side, like the technology or hardware or even software, everything is becoming obsolete in 3 to 4 year time frame. On one end, you see the cost of hardware coming down, but the technology is changing. So finally, if you add with all like the total expenditure, what you have to do, apart from the software, hardware, your AMCs, and if you add the compliance cost, if you add manpower cost, for many of us, the total expenditure or cash outflow, just combining both capital and revenue expenditure, the cash outflow itself goes to about not less than 15 to 20%. If you add the manpower cost also, which is becoming a significant one. As you said, when the technology is changing, you need to continuously skill, and the attrition rate, particularly in the technology sector, like particularly when it comes to like, I mean, right from the beginning, the problem was always that whether you want the bankers to become a technocrat or you want to convert a technocrat into a banker.
Right.
So ultimately, we turned out to that if you go and ask, it was neither, I mean, the technocrats were trying to talk a banker's language, and I mean, when I went to join my engineering college for chemical engineering, my head of the department started saying the definition of a chemical engineer. The chemical engineers are those who talk engineering in front of chemists and chemistry in front of engineers. When both are present, they will start talking politics. It was the definition he gave. The same thing happened for the, like say, particularly on the IT skill sets. But what we finally identified was that, like say, the 80% of the core group, and particularly the leadership of our IT team, they were hardcore bankers who were homegrown, and they were trained and, like say, I mean, normally in banking, you used to have people going from one department to other, but in IT department, right from the beginning, we ensured that we are creating a core people with the expertise and skill set. So they have to give the leadership, and they try to, like say, that 50-60% will be core, and the remaining operating, well, the attrition which you cannot, what do you call, control. So it's a continuous process. So I mean, every bank is finding out its own way of solving things like, unless and otherwise you have that core team, it's very difficult to make them understand the risk appetite of the bank and create the technology structure in such a way that it suits the basic DNA of the bank, and which we found out that hence the core leadership team has to be homegrown. But you have at operating level, you will be having, you have to manage the attrition. This is how we are managing this. So that reskilling continuously happening, particularly on the operating part level. But the entire, like say, it's a continuous process. You can't help it.
Right, right. The other issue is the recent example of the Silicon Valley Bank, which has seen flight of money all of a sudden, which probably prompted the Reserve Bank of India to it's still a proposal stage, a draft, to impose additional 5% runoff factor on deposits that are linked to internet and mobile banking, if it has implications for LCR. In that context, Mr. Mondal, the other side of the technology, that that is a huge risk that we are, of course, every bank is offering internet and mobile banking. So what are the risks? Do you see this as a significant risk, the flight of the withdrawal of all of a sudden withdrawals?
Manojit, this entire LCR issue which you're talking of, which will get impacted depending on the which bank we're talking about, depending on the composition of the deposits, can be anywhere between 8 to 12%. Okay, so on the LCR side. So, and most banks are actually on the LCR somewhere at a reasonable space at this point of time. So the larger question here is that, and I don't think that SBC, which you're talking about, the Silicon Valley Bank, SBB, it has no correlation with this, because SBB had a very different issue of doing long-term with short-term.
That is another issue, yeah.
So, and hence, it was basically a run on the bank. It had nothing to do with mobile banking or internet banking, or it was not even retail customers, okay, that much. So it was a run on the bank when the bank had failed because of their basic treasury business model, when it is bound to have a situation where people will come, and this is not a question of RTGS, NEFT or mobile banking, it's a question of people can go to a bank and also can withdraw, right?
Right.
This thing. So, and if banks want to stop or regulators allowed to stop, they can stop even mobile banking, net banking. So that's not exactly what I think RBI is looking at it. What they're looking at it is that previously, I remember when I was in HFC Bank, what we used to discuss is, what is the average tenor of a savings? And what is the average balance of a savings, and how do you calculate between an average balance and an average tenor? And hence, when you do your ALM calculation, how do you calculate it in your ALM, which is asset liability management?
Right.
Okay. I think what regulators are looking at it when they're prescribing this is that with now more and more UPI transactions happening, net banking, mobile banking, on your fingertips, things are there. How relevant is those tenor of savings accounts, average balance, is something which is basically they are asking. And hence, they're, as a prudent measure, they're saying that we must put some additional measures to manage your LCR better. I think that's fundamentally the issue. But the larger point here is, what can banks do about it? Let me put it this way. At the end of the day, these are regulatory measures, but ultimately regulators are doing things to ensure that the banks are safe and banks' liquidity is safe. That's the reason. So what banks can do to, in short, to manage the liquidity is, first of all, through net banking, mobile banking, there has to be either through your analytics or machine learning or various behavioral analytics, we have to figure out that how customer flows will change or has been changed, because broadly savings current account is a flow which depends on basically a behavior analytics which can be at play. Okay. The second thing what banks have to do is understand that how do they manage, because there are 4 parts to it. One is you have to manage LCR, you have to manage NSFR, you have to manage the CD ratio, and then you also have to manage your cost of funds. So how do you manage all these in the liquidity side? What banks have to do is they have to use more advanced analytics to say that what would be my tenor, what is be my average balance in these accounts, and is there any risk of outflow at any. The second part is where the risk is that the larger customers, whether it is a corporate customer, SME customers, or the high net worth individuals, private banking customers, what they can do is they can withdraw a lot of money, which can create instability into the system, and that's where the relationship management part comes in a very big way. So banks have to be in touch with their customers, they have to know, and if customers wants to withdraw money, then there should be a conversation before that, and that generally happens in most banks, larger banks, every banks it happens, and I think that's a discipline which banks has to inbuilt into it. So I think these are 2 different issues at this point of time, but I don't think it's a major issue. I think it will get played out over a period of time.
Mr. Prakash, what is your view on the draft norms, which is draft norms, which essentially links to, RBI had linked to internet and mobile banking?
Yeah. So, 2 ways I think I have to respond to your question is, one is the normal banking situations. So I think all banks are having different type of models. They understand the behavior of the customers. And these models are discussed in the ALCO. And generally, the machine algorithm also we work out. And generally, we understand that this much could be the flow. And more or less, it works in the normal situations without any problems. But the situation I think the second situation we are referring is when there is a crisis situation, a run on the bank. I think that is where the problem lies. Because whatever you do, in that situation, it will be very difficult for any bank to handle that. But the best possible way, I think, could be providing the maximum LCR. In case of J&K Bank, actually, we are operating in little sensitive territory. Because of that, we are always providing 10 to 15% extra LCR. That's why this additional, the draft circular which RBI has come, will not have much impact on us because we are already preparing ourselves on that scale. So, in my view, I think crisis situations will be a different ballgame altogether. But in the normal course, whatever models banks are following should be good enough. That is what I believe.
Right, right. Mr. Vikram, India is the biggest market for Maastricht outside UAE, which comprises 25% of the international assets. Can you throw some light on your future India plans, where you see yourself 5 years down the line?
Well, I would say like we are present in about 20 countries globally, and if I would say the top two focus countries for us would be India and the US, which are the largest economies from that perspective. So we are constantly investing in India. In fact, we're getting more capital in the country. We got some earlier in the year, we're getting more. So the idea here is to both expand our customer base, expand our product set. So we are looking for a, multiple of the India GDP growth in India. So typically, banks should grow 2 times the India GDP. That's what we are trying to endeavor and try and grow.
Right, right. But any plans to enter retail banking, to do a wholly owned subsidiary model, or you're comfortable with branch banking?
I would say it's little early on that side because we have enough of the growth and the runway right now in the present model. But obviously, never say never because things evolve. And India is a land of opportunity.
India is a land of opportunity. We are almost there. I just wanted to ask one last question. In all this digitization drive and all this brick and mortar banking, are they becoming irrelevant, or you still want to open branches, Mr. Kamakodi?
See, basically, like all the digital banking, account opening, so digitally, whether you need, this question is coming again and again. But our understanding, and probably, like say, if these things should have become true probably 30 years back, because this is being talked over not less than 3 decades, the same old thing. But what is very clear is that the number of transactions and the number of business and individual branch can handle, that productivity has definitely improved. So to sum up, it will be both the digital and the physical, both will be coexisting. And the number of customers and number of transactions that can be handled by the individual branches will increase exponentially using the technology. And the branches are also there to stay is our call, at least for the foreseeable future.
Right. Yes, yes, please.
No, I fully agree with Mr. Kamakodi. Actually, we have to see the brick and mortar banking in the Indian context. And I believe we have not reached to a level where the brick and mortar branches will become irrelevant. It is very much relevant, particularly the areas which like my bank is catering to. Still, there is a huge requirement of financial inclusion in those areas, and those areas require brick and mortar. The type of challenge we are facing in the liability side, the deposit side, we need brick and mortar because you go deposit money, nobody deposits electronically. You have to actually see the person and have interaction with him. He wants a lot of financial advice from you. Then only he will come and deposit the FDR or open the account, deposit account with you. So I believe the brick and mortar is very much relevant. Yes, we have to transform the brick and mortar in such a manner that we became from the transactions to advisory model. That is what is required, I think.
Right. Mr. Mondal, you want to add?
No, this is a very vast subject, but in short, because time is over, so I'll just say that this debate used to happen when the entire digital transformation journey had started a decade back.
Right.
I don't think this is a debate anymore. I think we need both digital as well as physical. Look at the number of branches which the larger banks are opening today.
I know.
And go beyond Indian shores. I mean, I had a debate in a board in one of the banks a decade and more back. And today I'm happy to say that I think I was right, because somebody said that people have to start shutting down branches instead of opening branches. And then the same example I gave that time, I want to give it again now, is look at US, for example. Okay, on this side of the road, you will see a chase. On this side of the road, you will see another chase. Because there the cars cannot take a U-turn. You have to go and you have to do a banking and move on. So it's not a question of which one, but the way the banks used to operate before, that has to change, and that is changing very drastically. The entire floor plate, what you do in a branch, operations, most of the things has to be centralized, digitized, all of that. Customers may or may not have visited the branch. I had done a physical survey of how many percentage of customers way back in 2011 in HFC Bank. And I saw not more than 13% customers even then visited a branch, okay? But you need a branch because if you do wealth management, if you need to even have your sales guys who are acquiring customers, where they do it from? So the whole concept, and this is what I told, that somebody said that, physical brick and mortar is not important. I said that in my childhood, we never went for coffee to a shop. We had to have coffee at home.
Right.
Now, you see this young generation, they give the logic that young generation don't use physical. I said, but they go to Starbucks for a coffee. We never went to Starbucks for a coffee. So you have to create the right environment.
Right.
Okay?
Right.
And the right ecosystem to make people come to a bank, not to withdraw money, not to do operational transaction, but to go to advices, as he rightly said, and to create an ecosystem of banking which is beyond banking. So I think that is evolving over a period of time. I'm not even getting into a metro, urban, tier 1, tier 2, the touch and feel banking on the ground, etc., in a deeper geography, how it works there. I'm not even getting there. Even in a metro, you need branches, but the branches, floor plates will be much smaller, and what we do from those branches are very different. So I'm a big fan of a brick and mortar, if you ask me.
Thank you, thank you. We'll take a couple of questions because we are completely out of time. Anyone want to ask a question? Yes, please introduce yourself and be specific with your question.
Hi, this is Prasad. This is Prasad Ramaswamy. I head the transaction banking for Union Bank. I want to ask basically, it's a very important session, really good insight. In a very short thing I want to ask, there are 3 C's, the challenges that we are facing, entire banking. That is the consistency, the connectivity, and the communication. And today's world, if you see, it's all about customer experience and user experience. So when customer experience and user experience pitch in against these 3 challenges, consistency, connectivity, and communication, how do we actually control this? And how, as a regulator, we need to also satisfy the regulator, at the same time also pacify our customers. So how do we see it? This is what I want to ask.
Basically, you're asking the balance between regulator and customer. Who want to answer that?
Mr. Ramaswamy, I fully agree that these are the challenges, but the weakest link is the human part in this. And if we fix the human part, I think most of the machine parts will be fixed. And that is where the debate is, that how to upskill, and then unlearn the things every day when so fast the dynamic changes are happening. So I believe we have to focus more on our human resources, and then technology can be fixed through human resources. That is what my...
Just add to this. No, absolutely. Ultimately, people makes a difference. But what is more critical is, I think, customer expectations, and rightly so, and hence regulatory expectations are constantly going up, which is part of a progressive country. So go back when you would not get a cash credit into your account, you would not get a credit into your account because of this intercity checks and all this when CMS used to happen. Okay, now you try doing that, you will be out of business. So the question is, over a period of time, as we're talking, as recent as recently, now your transactions, electronic transactions has to be 24/7, 365 days a year, right? And banks have to live up to. When CTS happened, for example, another evolution happened. So what is happening is now, banks are evolving. All three, I think, we are improving constantly, but customer expectations are going ahead of the curve, which is very good because it's a part of a progressive country. And regulators are pushing us. As we are talking yesterday, there is a regulatory call, and from DFS, there's a call on customer service, on which how they themselves are pushing the banks to take it forward in terms of what customers are expecting and how they are intervening. DFS is intervening in saying that what banks should be doing on the customer service side. So I think it's an evolving scenario, good for the country, creating efficiency, creating pace, creating communication. I think all is happening, but of course we need to do better.
Yes, last question. Please give the mic. Please introduce yourself and be a short one.
I am Professor Sridhar. I am a banker moved to academic. What I find is when we are trying to groom talent and provide talent to the banks, there is a big, though it's not in banking, but on HR related question. There is aversion for the youngsters to be in the business development side of a bank. Whereas if you say 10, 15 years back, everybody used to be a career banker. Anything as a system or something we should do to make the young minds to be part of banking, that on the business development side where many roles are there. This is a concern which we find it in the management side.
You want to answer that?
Yeah. No, very interesting question, actually. So I think, first of all, let me accept banking is a boring business, right? And bankers are boring people. The youngsters today don't want to be in a boring business. I mean, that's jokes apart. But on more serious note, I think what's happening is the inter-career opportunities and options. Because ultimately it boils down to banking, because a lot of this digitization, digital, fintechs, all of these things are happening is also coming in a way back to the banks. And a lot of this work is going outside the bank into some of this where the youngsters are coming and building. Entrepreneurship is significantly picking up today. And a lot of that is happening on the technology side. So given all that perspective, it is a good thing which is happening in the country, that everybody is not queuing up outside a bank to join a bank, okay? And also truth is that with more and more technology, AI, ML, all of this starts, when they start happening, a lot of these things which are happening in the bank through people will happen through automated processes. And hence good that there is a larger ecosystem which is evolving where there are more and more jobs which are getting created. And people will get innovation as a part of this thing. Having said that, I think banking has enough innovation to do within if they want to come, but you need to have a slightly longer perspective, longer mindset to come in a bank, settle down and grow with the bank. Maybe the patience today among the youngsters are a little lesser, so they want maybe a little bit quicker gratification, which banks unfortunately cannot. A regulator entity cannot give a quick gratification, and that takes time. So, but if you invest yourself in a bank, I think you will definitely grow.
Mr. Kamakuri wanted to add. Yeah.
So just to add to Mr. Mandal, the same complaint is being told not just by the bankers. If you go and ask a core engineering industry, they also say the same thing. So it's basically, I think we all have to request to you academicians, when you teach the students, kindly make them to be closer to the reality. There is a huge gap between when they are, probably like people from our generations, pre-liberalization, we had a lot of, we went through, like when we grew up, we had a lot of shortages and all, but when the next generation grows, probably it's a problem of plenty. So the expectations need to be properly tuned, which needs to be done by the academicians when you teach. So our request from bankers' side to you.
Thank you. We have completely run out of time, but thank you so much for all the...
On behalf of panelists, we want to congratulate Business Standard for the 50th year. And particularly the bank just crossing our 120th year, probably we have senior among the panelists to wish you all the best.
Thank you so much. Thank you so much. And please a warm round of applause for all the panelists here for an excellent discussion.
What a fantastic discussion that was. Absolutely fantastic. Two data points that stuck out was that, banks in India are dealing with some 1.2 million cyber attacks in a week. And the amount of time CEOs are spending on, like 30%, I think, on compliance and cyber security is quite something. Thank you so much. Wonderful discussion. Could I please request Manager to please extend a token of thanks? Ladies and gentlemen, tomorrow will be the third and the concluding day of the Business Standard BFSI Insight Summit, and we'll begin the day the registrations will start at 9 a.m. tomorrow. And for now, we have in the next hall, we have a stand-up by Varun Grover. So do please go to the next hall. Have a good evening.